A very warm good morning to all participants for the third day of this advanced GST certification course. Before getting into today's introduction, I just want to give two important announcements to participants. The PPT relating to today's session is being shared in the chat box. The link to the PPT is being shared in the chat box, so the participant can use that link to download the PPT. If further, we would also send a mail to all participants individually with the link so that you can download it and use it further. The next thing, we have scheduled today sessions on exemptions and valuations. Due to unavoidable circumstances, the valuation session has been postponed, and today instead of valuation session, we would be taking upon input tax credit. So today's coverage will be unresolved and resolved issues in exemptions, relating to exemptions, along with landmark decisions in GST regime and S12 regime. We should be taken up by the eminent speaker CA.VENUGOPAL Gella, and the experts to add upon the value for today's session would be CA VASANTH sir. So with regard to introduction of speaker, CA.VENUGOPAL Gella is a partner in Venu and Vinay Associates. He qualified in the year 2002 by securing All India 45th rank. He is also a certified information system auditor. He has completed various other certificate courses from ICAI, namely DISA, course on business valuation, internal audit, fraud detection, and forensic accounting. He has also completed 1-year course from IIM on data analysis and business intelligence. He is an active speaker at ICAI on GST, especially on technology and its implementation challenges. He has authored various industry-specific handbooks on GST. He has contributed to technical guide on GST audit released by ICAI and other publication materials. He conducts workshops on filing returns with use of automation. He has developed a lot of Excel-based free utilities on GST like JSON Reader, creating JSON files, GSTN Validator, composition versus regular benefit analysis, GST Impact Reader, real estate project, switch decision analysis, etc. He is a GST faculty for ICAI and conducted various workshops and webinars. He has been co-opted to Indirect Taxes Committee of ICAI for the financial year 2018-19. He is core committee member of FKCCI GST Wing. He advises on technology for GST implementation and integration of accounts and return filing utilities. His other areas of practice includes designing and development of internal controls and process documentation, consultant in ERP implementation or migration, management consultancy for business analysis, growth, design of management information systems. Apart from audits, he is hands-on coding in VB, .NET or Python. He also reviews database design. He conducted various workshops on corporates regarding use of technology, improve efficiency at work using Excel, building automated reports from accounting and financial appliances. He was behind in the development and managing of cloud applications like TaxSmile, Insta Financials, and others. With this brief introduction, I would warmly welcome CA.VENUGOPAL Gella sir for taking up today's session. Welcome, sir. Kindly take it over the session forward.
Hello, everybody, and thank you, Arjun, for your such a kind and wonderful introduction. Let me just start the screen. Screen is visible, right?
Yes, sir.
Okay. All right. Okay. So, firstly, thank you to the Hiragangi Academy team for doing such a wonderful sessions, and the webinars of Hiragangi Academy are definitely of the class and very high standards, and the advanced analytics classes are really expecting people to think beyond. And I also thank the Academy for giving me an opportunity to share some of the views. And with me, Vasanth sir is there, and he would definitely add wherever something which I'm not covering. For the participants, let me tell you, the PPT is covered little exhaustive, so that you can refer it at a later point in time. In the, I would be skipping some of the slides which are of not much relevance, but I thought I'll give you a glimpse of what is that you should look at when you are dealing with the exemptions. The coverage for today would be, I would definitely give an introduction, though I know it is an advanced thing. I'll just spend 2-3 minutes on doing an introduction to the exemptions. Then we will spend more time in analyzing the section 11, the exemption per se. Then we will look at certain important principles of the exemptions, looking at various court decisions. Then I will take up some of the specific exemptions which are given, what would be the issues in those exemptions, and we would look at the couple of very important judgment in the exemption related. Then we will wind up with Q&A. Before I begin the session, I should definitely thank Anil and my colleague Dhanashri, also part of in putting up this presentation for me. Right. So with this note, let us start the session for the day. Firstly, what are the things one has to learn? One has to learn and understand what an exemption means or what an exemption is, and the levy of the tax per se. Since there are wholly exempted, partly exempted, the levy of the tax, what is the levy which is being made? So we need to also understand the levy perspective. Then certain general inclusions which are there in the exemption. Then the exemptions are classified qua-supplier, the type of supply, or sector-based exemption. We have specific exemptions. That is what we are going to look at it. Just to give an introduction to the basics of the law, Arjun, just remind me 5 minutes before I have to wind up in case if I'm delaying. Yeah. Certain basics of the law. Firstly, the literally why we call things are exempt. Exempt means these are free from tax. There is no levy. The moment there is no levy, there is no cost. We know under GST, eventually GST is going to be a cost. Between business to business, there is no cascading effect. But whatever being produced, whatever is being sold, ultimately it lands on to the end customer. Whatever be the type of supply, whatever be it, it has a final touch to the end customer, which becomes a cost. Now, if something were levy on the cost where there is a tax, for an end customer, he is not going to get a credit of it. It becomes a cost to the end customer. So that is where exemptions play a very important role. Now, exemption notification, it only suspends the collection of liability, sometimes wholly or partly. It does not negate a liability per se. Okay. So one cue I would want you to take, if there is an exemption notification for certain good or a service, there is a levy for that item. It is leviable to tax. So government is foregoing tax for the purpose of benefit of the taxpayer. They are foregoing the tax. So that is how one has to lead the exemption. So if you look at various types of supply, there is a taxable supply, zero rated supply, exempt supply, and non-taxable supply. So exempt supply is also one part of the supply. Now these exemptions which are given, they are into multi-fold classification. There are exemption up to certain threshold limit, there is no levy, or blanket irrespective of the threshold limit, there is no levy. To claim an exemption, I have to fulfill certain condition, either sometimes before the sale or after the sale. Some exemptions are time-bound exemptions. Some exemptions are wholly from GST or partly from GST. Then there are exemptions supplier specific, receiver specific, or provider specific. Okay. When applying the exemption notification, you have to ensure abundant caution you have to take up, and everything which is there in schedule 3 is also you can in a way consider as an exemption. I'll come to it little later. There are ad hoc, the law has a provision to give an ad hoc exemption by way of special orders Then we have pure agent transactions. So treatment of that I'll touch upon. And exemption is part of your turnover. Okay. But exempted turnover very crucial for the purpose of computation of input tax credit. What is the impact of having an exemption? Now, exemptions are very few. Out of the total supplies, we have very few exemptions. The impact of the exemption is it distort the seamless input tax credit chain. The supply chain gets curtailed whenever there are exemptions which are given. We say in GST, GST has a seamless credit, but the moment certain item comes as an exemption, the chain is cut. How do you say the chain is cut? Because we know under the law, an exempted product when supplied, input tax credit is not available. So I am selling cereals, pulses, dal, rice, exempted supplies. Now, in the whole of the chain, the GTA services have taken, or the commercial establishment rent which I am paying, all these input tax credits which were available to a business as passing on for the offset, it stops and becomes a cost. All right. So that is how it is. And we know the tax has different connotation. Tax terrorism, we try to, there are people who try to escape the tax, and they are business people who are very creative, adventurous to come up with complex transactions and change the nature of the taxation itself. Now, if you look at the definition of exemption, a basic exempt supply 247, there are three limbs to it. First limb says it means supply of nil rate of tax. So nil rate means, in fact, nil is also one rate of tax. 0% is also one rate of tax. That is on exempt supply. Then something which is wholly exempt under section 11 or 6 of IGST. Then it also includes a non-taxable supply, right? So we will focus more on the section 11 analysis, because whatever which is rated marked as nil, we know it. Now, the first segment which is said nil rate of tax, where the tax rate is nil. So there are judicial precedents which also said whenever the tax rate is nil, it is under the ambit of the levy, and it has to be treated as one of the element of a taxable supplies, and tomorrow government can change the rate of tax also. Then the second segment which is saying wholly exempt from tax under section 11 or section 6 of IGST Act. In the whole of my discussions today, I'll be spending more time on this. This is what more important. So let's understand the section 11. Section 11 have three subsections. Subsection 1 says government has power to issue a general notification, either absolutely or specific to a condition, exempting whole of the supply or part of the supply, or a specific exemption. It can give a specific exemption and by a special order. So special exemption by way of special order only when there are circumstances of exceptional nature. Then the 11 subsection 3 says it can also have a retrospective effect. So what are the important words one have to read in 11 subsection 1 and 2? I have highlighted in the red. So the exemptions can come by way of notification. So something has to be notified, only then it becomes an exempt, and it could be absolutely or subject to a condition. So the exemptions come with a condition. So you cannot tomorrow say that if something is exempt, it should always be a blanket exemption. The primary moot question is exemption mandatory? Yes, exemption is mandatory. You can say that, okay, I will not choose exemption, I'll pay tax and I will input tax credit. No. If something is given as an exempted, it shall be used. So person shall not collect the taxes in excess of the effective rate. When effective rate itself is not there, you cannot collect a tax more than whatever it is specified. So if you look at the various sections, various things in the section level, first, the exemptions should be of public interest. It cannot be of an individual interest, and this was well discussed in the Union of India versus Unicorn Industry. Now, exemption notification can be withdrawn in the public interest. So the government can introduce in the public interest, and also it can withdraw in the public interest. So in the case of Kasnika, it has also been explained that the exemption notification can definitely be withdrawn in the public interest. Now, the public interest. So what is public interest? When we say public interest, what is public interest? So it has to impact people at the large. And in one other case, the Dilip Kumar versus Commissioner of Customs, the couple of important points which have come out is, if one is claiming an exemption, the burden to prove that they are entitled for exemption is purely on SSE. You cannot say that, okay, I feel it is exempt, so I am claiming it. If you feel it is taxable, you prove me why it is taxable. The burden is always on the department, on the SSE, to prove it to the department that why this exemption has to be applicable to me. And please note, if there is any ambiguity in the exemption notification, the ambiguity, the benefit cannot be claimed by SSE. It should be interpreted in the favor of revenue. We have a very recent Supreme Court judgment also, which is saying that it has to be in the favor of revenue. So please, whenever you have doubt, you have to prove, and the burden to prove is always on the SSE, right? Now, couple of other points. Whenever there is something ambiguity in the law and it needs an interpretation, the revenue or the authority or department should interpret liberally. No? And the principle of the law is, in case if there are various conditions of eligibility is laid down in an exemption notification, so it has to be construed strictly. And if the applicant is found legally satisfying the exemption the condition, so we cannot look at saying that that end or dot comma is missing, right? So there cannot be addition or subtraction to the words which are given in the thing. So as long as we get a clarity to that, we cannot again further add some more words and or making it little ambiguous. I will discuss this point again when we come to RWA exemption notification. Now, a couple of things where the people have to be aware is, we know there are always council meetings happen. Just because in a council meeting someone decided, yes, we got to give exemption benefit to it, people can definitely not adopt it. There is a finance minister speech in the budget. Merely based on the finance minister speech, one cannot take a benefit, right? And if a taxpayer is not taking a benefit in the initial stage, like he is not aware, he is ignorant, he is not taken the benefit, it doesn't also mean that he is foregoing the benefit. He can always, at a later point in stage, he can always claim, saying that, okay, that benefit is applicable to me. And if the taxpayer is fitting into two notifications, there are two notifications and the taxpayer is fitting into two notifications, then he can claim anything which is more beneficial to him. The choice is him. If there are two notifications which is applicable to him, he can definitely choose what is beneficial to him. But it cannot be the department saying that, no, this is the notification you should forego and you should apply this notification. So we have in Share Medical Care case versus Union of India. So this also has established that out of among the two, if the SSE he is satisfying both and he is choosing one, that is also permitted. Now, if an exemption is granted, one has to be very clear that it is taxable. So if an exempt means it is leviable. So if something is exempted, so it means it is leviable. But however, so there is also a thing saying that to avoid ambiguity and an extra abundant caution, so the government sometimes can grant an exemption. So there is, it has also established that, so to ensure the misrepresentation or misinterpretation by the department, so to become an extra abundant caution saying that these products I do not want to tax it, they can also bring under the ambit of the exemption. Now, the mere laying something under the thing, so whether it comes under levy, it is always a question. And the classic example for the discussion of this is sale of land which is there in Schedule 3. Now, in Schedule 3 where it is mentioned the sale of land, constitutionally does GST has power to levy tax on sale of land. But if you look at the definition of the goods, which has a connotation to movability, land is an immovable property, so not a good. But when you look at service, service is anything other than good. So by virtue of that inclusive definition of the service, land becomes as a service. Now government has to be an extra abundant caution saying that okay, I am not levying tax on it and they have to put it under Schedule 3. So sometimes we also have to presuppose that okay, there is an extra abundant caution government has taken. But back of the mind, please note, if an item which is provided as an exempt, there seems to be a levy which happens. Now, I have been saying about something which is wholly exempt and partly exempt. Now, what is wholly exempt and what is partly exempt? Something is exempt from whole of the levy, it is wholly exempt. Most of your input tax in input tax credit reversal, you have to apply the exemption if it is wholly exempt from levy. If it is partly exempt from levy, it doesn't invoke reversal of your input tax credit. So whenever you are reading an exemption, you have to read whether such item is a wholly exempt or a partly exempt supply. Now, what is an example of? There are many partly exempt supplies. There are notifications which have come. In case of this merchant exports, the rate of tax we look at it as 0.1%. Now, how did the government say it? Government said beyond this supply, the value beyond 0.1%, wherever the rate is applicable, the value is treated as if it is exempt. So, in the portion of the 100 portion, they said 99.99 is exempt, 0.1 is taxable. That's how it. Now you can see there are partly exempt supplies also. Now, from the levy, from the ITC perspective, what we have to look at it is wholly exempt. Next thing, when you are reading interpretation, wherever the rules of interpretation which is there, especially with respect to the classification. Now, the classification under the tariff is for your HSN classification, but you cannot you cannot literally interpret for the exemption notification also. So you got to classify the product. Post classification of the product, you got to check whether it falls into an exemption, not in a vice versa saying that you classify this exemption into this HSN category, then everything in HSN is exempt. It is reverse. You classify your product and see whether this product falls into that HSN or not. Then the word now in the phrase versus now exempt from the duty, and this is a classic excise case where what is the effect of the word is the exemption from when it is applicable is also discussed in Mahakali Rolling Mills versus Union of India. Next thing, what is the effective date the exemption notification is? Generally, most of the notification when they are notified, it gives an effective date from when it is exempt from. In case there is no effective date mentioned, the date on which the notification has come into effect, that is an effective date. However, under 11 subsection 3, government also has a power to notify something as exempt 1 year prior also, where there was an ambiguity. One set of the dealers were treating this as an exempt. Government was also thinking that it is an exempt, but there is another set who is seeing as taxable, or department is saying taxable. To give a clarity to it, government can also bring. In fact, in one notification, I think in July 2018, we had one retrospective saying that okay, this product is an exempt. Okay, so the government can also notify an effective date, and by virtue of power under 11 subsection 3, there is 1 year behind, they can move for the exemption. Now, there are a couple of exceptional circumstances depending upon the facts or the circumstance or past antecedents. The object and purpose of the intention of the exemption notification, the doctrine of fairness, they look at all this, and courts also held that certain exemptions can be applied retrospectively. Okay, so even though such retrospective is silent in the notification, certain things looking at an exceptional circumstance. That is why I have highlighted in the red color that it is only in exceptional circumstances. It cannot be applied across. Only then it can be looked if the notification is silent. So I've listed where the case laws where this has been considered and decided. But please, whenever an exemption notification is given, if you want to intend to apply retrospectively, you got to put an abundant caution for yourself. Now let us look at some of the activity based issues in the notification. Firstly, we need to know when it comes to the registration, if anyone is dealing with wholly exempted supplies. If anyone is dealing with wholly exempted supplies, they need not register. So this is one has to consider. Just the point one has to note it is wholly exempt and whole of the supply is exempt. If even a portion of it is taxable, he has to register. Next, impact on input tax credit. Even input tax credit, we know one cannot avail an input tax credit. One cannot avail an input tax credit if the supply is towards affecting an exempt supplies. So if there is something exempt supplies, one cannot take input tax credit that which is towards an exempt supply. When we say exempt, which is wholly exempt from tax. So the two subsection, if you look at the 2 subsection 47, the definition of exempt supply, it means it is wholly exempt from tax. So this is one has to very carefully note it, supplies which are wholly exempt from tax. Now coming back to our so wherever an input tax credit which is used in the business, we get a credit 17.1, and used for taxable supply, we get a credit 17.2. So which is not for taxable for supplies, we do not get an input tax credit. This is another impact of the exemption. And all the common supplies are subject to rule 42 and 43, where the exempted supply is the numerator. To that extent, the input tax credit is not eligible. Next important aspect in the exemption related, whenever a supply which was earlier taxable now becoming exempt, so moving from taxable to exempt or exempt to taxable, there is an element of reversal of an input tax credit or reclaim of the input tax credit. So applicable for input in work in progress and capital goods. It is not applicable for input services. Now let us look at the activity based exemption. First aspect is goods. Now we know the goods which are of common public use, they are exempt. So all the notification for the goods, you would firstly the exemption notification for goods you will find in 2/2017 updated time to time, and for services it is 12/2017 updated time to time. So list of items we can find it, and all these items are something which a common man using on a day-to-day basis, such as atta, maida, besan, food grains, etc. Now one important thing which one has to know, it is unbranded. If something is branded, then it is not taxable. If something is branded, it is not exempt, it is taxable. What is exempt is unbranded rice, unbranded atta, unbranded things. So if something is sold as a brand, why it is taxable. Now how do you identify the brand? Brand means someone is having a trademark right, copyright, or any other thing which is time being in force. So under any of these acts, one has taken a trademark, copyright, and they are supplying it, it is taxable. Now one may say, because my product is taxable, cost of the price has gone up, I want to sell it as an exempt. Government brought a notification saying that if you are willing to forego your brand, how do I say? They said in the newspaper, you file an affidavit and you publish that you are foregoing, and all the materials, all the printing materials, if you clearly print saying that he has foregone the actionable claim or the enforcement right on the brand, then it becomes unbranded. Hence, the moment it becomes unbranded, it's outside the levy perspective. Only one point one has to be very careful. Even though certain item is unbranded, but if it is sold in an exclusive store, then it becomes a branded product. Let me give two examples. There is something called Shivling Tur Dal, and in the South India that is very associated brand name for the Tur Dal, and people relate to it as a very quality premium product. For some reason, the moment I put Shivling Tur Dal and Shivling is a registered brand, it becomes 5%. He registers it so that no other person can copy that thing and do it. Now he relinquishes his right. He says anyone want to put, you can put it. Like for rice, we look at Sona Masuri rice, right? Now Sona Masuri is like the type of thing. It doesn't mean that it is a branded rice. It is one category of rice, right? So even though something is branded, if the brand is being relinquished, then it is outside the levy. Contrary, let's look at an Himalayan product. Let's have some Himalayan, I'll take a simple example, lipstick, which is anyhow we know taxable. For a moment, if it's a branded lipstick is taxable, unbranded is exempt. Even though if I do not put any label on that lipstick, but if I sell in Himalaya store and in that store it is only Himalayan products are being sold, then it takes the coloration of the branded. So one has to be very careful. If an unbranded is sold in a branded store exclusively, that product is being sold, it would take the coloration of the brand. We have Arvind, an advanced ruling on this for Arvind brands also. Next aspect is supplies of the government transactions. Now, this is a peculiar thing. Firstly, we know government to government is exempt, supplies to the government, and under section 7 itself, they have a power to say certain activities which are done by the government will not be treated as supply. And especially the panchayat local bodies which are doing under the article 243 G and W of the constitution. And whenever the supply is made to the government, we now know that it is taxable, and supplies made by the government to the end person, most of the supplies are under reverse charge. Most of the supplies by the government are under reverse charge, except the following, which is postal, aircraft, and passenger transportation related services. Now, leaving this, even immovable property came under reverse charge at a later point in time. So, leaving this, everything is under reverse charge. What is exempt is in case of a continuous service and the value of the supply is less than 5,000 rupees. So, only that is exempt, rest are all taxable. Now, let's understand what is the ambiguity or issues in the government supplies. Firstly, the government, is it really providing a supply, or is it a constitutional obligation, sovereign function, statutory function which government necessarily has to do it? How do one benchmark the difference between both the aspects? Now, there are very thin line of difference. Postal service is general post is exempt, speed post is taxable. General like stamp which is being sold is exempt, but that it is instead of general, it is a speed post, it is taxable, right? So when what services is being taxed is now going to become a challenge. Whenever government is at par with private in providing any services, so how do you identify is if government and private are providing the service, the public sector banks it is wholly owned by the government, but still there are private sectors. So whenever government and public are providing the similar service, you should very well know that it is a supply and leviable. The question that comes is where they're acting as a function of public authority, then how do we identify what it is? So there is firstly no clarity on the government service, like what is a government? Is the state government, central government, only the government, or the departments under the state government service, central government is also a government, or the entities which the state government, central government have constituted and they are providing the service is also a government. So where does the expansion of the government goes? And certain services where there is no clarification. Let's look at one of it. Recently, we know in the last to last budget, there is an amendment which has happened, and the government said service by way of grant of alcoholic liquor license against a consideration or license, whatever by the name it is called, the government said that okay, this is outside the levy of service tax. So they said they have eliminated it from the levy of service tax. Now the moment they have said it is outside the levy of service tax, there are two questions one needs to look at it. It's outside the levy for service tax, but the reasoning for it is not given. Can we apply that all the license fees like spectrum license fee, mining royalty which is paid, are they can be exempt? Like what is the rationale? How can I apply it? Now the exemption is given under service tax law. Can I take the application of the same thing under GST also? Can the same thing be applied? Because the at least where there was supply of goods and services, but together we understand that okay, we cannot apply pure VAT or service tax, but this is pure services erstwhile and now. The ROC fees which is collected for increase in authorized capital, is there a service, is there a levy, will there be any tax which needs to be paid? Because if we say there is a levy, definitely government will not have an issue, because government all the supplies made by the government to a business has to pay, and the reverse. The issue comes is if this is exempt. Now supply by the government is exempt, but the certain supplies are taxable. If you look at the entries in the notification 12 and 11, where there is exemption for the government supplies and the taxability of the government supply, the thin line of difference, what is the statutory levy and what is an incremental levy, is not given. For example, I apply a stamp, say registration fee which needs to be paid. Now I have taken a register, I paid to shops and establishment department, I paid some amount, registered and paid the money. Next year I have to renew. To keep my license effective, I am paying the renewal fees. Can the renewal fees take the connotation of the registration fee? Because registration fee they have given the exemption, but would the exemption be applicable to the renewal? It is still unresolved. So there are issues under the law which is still unresolved. Now anything which is unresolved, how do you take? So it is always whenever the supplies which you are undertaking, you better take a legal opinion. Ask an expert opinion and see whether this can I consider as an exemption or is it supply. Next comes a real estate transactions. In case of a real estate transactions, we know pure labor contracts. Firstly, supplies to the government pure labor and the construction of an individual residential unit is exempt, and it has to be pure labor. It cannot be goods plus labor. Where later they have amended and said the composite supply of goods and services up to 25% can be included. When it comes to the supplies to the government, up to 25% they have said we can include that. Next, renting of residential dwelling. And one other aspect in the real estate which we have to also see that it is an issue is in case of a real estate, the joint development agreements, the development rights which have come under the levy perspective is also a subject matter, because development rights they have said that it is taxable. All this while the landowner were thinking that okay, it is eventually I am giving off my right on the land, so it is akin to the sale of land, it should be never under levy. But with the amended notification from 3/2019 to 5/5/19, so they brought in it is reverse charge in the hands of the developer. So one has to be very careful. Next aspect on the real estate is the residential dwelling. Commercial property let out, taxable. Residential property let out, not taxable. But what is residential? It is not purely defined. And what is the period? It is not defined. Question comes is paying guest accommodations. So I have a unit, I am renting it out for people to come and stay, and they're using it, they're living for their staying purpose, exempt. Instead of one person, I am letting it to two persons. Just that two persons are staying in the same house. So in one house, I have 3 bedrooms. Each bedroom I have let out to one person. Residential use. Extended, in each bedroom I have put the cots. Now the residential dwelling is now changing into accommodation services. So one have to also find where do they draw a thin line of change in the nature or the activity. Next, services by way of this long-term lease, where the industrial, the government to set up the industrial things, instead of giving the land outright sell, they give as a long-term lease. Now this was under the levy. Of course, the recent the amendments came in and they said if the lease is beyond 30 years, then it is exempt. It's just that this person who is giving it on the lease, it cannot be an individual. It has to be someone, the state government, industrial development and others. The question comes, if it is not by state government, it is by some undertaking, what should be the impact of it? They said if it is by any other undertaking, at least 50% or more the ownership should be by state government and central government. So this is one area one has to be very careful. Next, in transportation services, we know transportation of passengers embarking from these states, these locations, air transportation is exempted, and the road transportation, they said stage carrier, contract carrier, non-AC is exempt. The definitions are available. Now, in case of the other than air road, from railways, they said first class and AC is taxable, rest are exempt. Metros completely exempt, and inland waterways completely exempt. In case of auto rickshaws, metered is exempt. So this is what is given for passengers. And for goods, they said GT, transportation services of goods on road is exempt, other than provided by goods transport agency. Then inland waterways, air is given. Let's look at what are the issues. In case of a passenger transportation, one has to carefully look at. Now, if you look at the services, you need to identify if I run a fleet of the services. I have to identify the supplies relating to AC, supplies relating to non-AC, and this is place where people embarking or terminating from these locations. So whenever a ticket is booked, the system have to be designed that only this have to be exempted, that others have to be taxable. The issue comes when someone is doing an audit. How do they define? Okay, even the for the rail, they have given if you are carrying these materials, it is not taxable. Other than that, any, like you may put your bike for transporting from one location to other location, all other services are taxable. So the same way given to the GT also. The issue is how do you track which type of good was transported and the exemption is applied whenever during the audit. So one has to be very careful that okay, these exemptions are specific to category of the goods. So there should be a specific documentation. Next, the issue. Yes, Arjun.
Sir, can you turn off your video because I'm facing little low bandwidth, so the recording is getting little bit disrupted. Can you continue without video, sir?
Yeah, I turn off the video.
Yes, sir.
Yeah, okay. Done.
Okay, sir. Okay.
All right. Now
you can continue, sir.
Yeah. So the next thing is, how do you track this exemption which is given only to one category? How do you track that would become an issue? The other point of the issue that would come up is transportation of goods by road is exempt other than the transportation made by the GTA. Now, how do you differentiate between GTO and a GTA? So, there is, you want to just give, you went to market, you purchase an item, then you are looking for some carrier, you'll find some autos or trolley trucks there. You say, can you just move this goods from this location to my office or my godown, whatever, that has been done. Now, that person who is carrying the goods, he is not going to give you any receipt. He is not even engaged in the organized transport. He is going to levy, but he is not going. He mostly is an unregistered and is a GTO. It is an exempt service. But how do you differentiate? Now, the word GTA is anyone who is issuing a consignment note. What is a consignment note? Any document becomes a consignment note. So when there is nothing is defined, it also becomes a very difficult where to identify between GTA versus GTO. Next category, lending related services. We know all the interest earned is exempt from levy. There is no levy on the interest income. Now the question that comes, there is, since it is not given specifically, my point is, will the intercorporate loans given by companies, would it be applicable to this, or is it applicable only to the banking services? Now in the initial interpretation, I have said whenever there is no clarity given, you have to harmoniously look at it. If one entity is giving a loan to another and it is not an NBFC, still it is an interest income. Any interest earned on the advances would be covered into this category. Next, on educational institution, we know educational institution means it is preschool up to higher secondary, and after higher secondary it has to be a curriculum which is recognized by the law. Up to higher secondary, it is all educational institutions are covered and includes a vocational education course also. And whatever the services they are providing to its students, staff, faculty is exempt, and someone who is providing services to an educational institution, transportation, catering, security, and admission, conducting exams for admission is exempt. So one is by educational institutions. What is the issue there? The educational institutions, when they are providing services to its students, staff, and faculty, now the question that comes is, sometimes the educational institutions undertake this touring activity, and today the touring is also an international touring. So from the student, they collect 2 lakh rupees, they go to some education exchange program to Australia for 1 week, 10 days, and they come back. Now they have collected a huge sum. Is it a taxable service or is it an exempt service? Now the point that one may come up is, okay, this is supply is provided to its students, staff, and faculty, so it is exempt. Now, but the survey, is this service in relation to the education, is the next question that would come up. In my personal view, it is also in the course of education. It should be an exempted levy. The other, when the supply is provided to an educational institution, whether it is transportation, catering, security, the point one has to note here is, if this is exempt, the supplier has to keep an accurate records or the information, because he might do a transportation services to an institution other than education and something to an educational institution. So transportation is at a lower rate of the 5%. So in that category, how do one justify that, okay, these are the exempted supplies? So this is also another point one has to be very careful of. So keeping track of the educational institution from the supplier perspective is going to be a challenge. And the input tax credit then, because some of the supplies are taxable, some of the supplies are exempt, and it is in the same line of business, which means whole of my input tax becomes common credit. Earlier it could have been either T4 or T2. Now everything becomes a common credit. That's another issue. The next issue is on the charitable organization, charity and charitable organization. this is a first entry in the notification 12. Services by an entity registered under 12AA is exempt. The questions that would come is, what is a charity? They have listed out, these are all the activities only treated as charity. Now, generally, the biggest challenge in the charitable institutions is person who is contributing the money, he is not the recipient, and the person to whom this institution is providing service to, he is not making the payment. Like, I conduct some health camp, I do not collect any money from the people who are coming attending the health camp, but someone is paying the money to me. So when someone is paying the money to me, where is the nexus? I prove that I do this, and I am an institution where I am doing activities which are fitting under this list, and I am also doing an activity which are not fitting in this list. How do I identify? Because charitable institutions generally do not collect money from the person to whom the recipient is. They are contributing, like into the COVID, they are contributing medical kits. They are contributing some rice bags. Someone is giving the money to them. Now, some of the items fit into this, some of the items do not fit into it. So the challenge then comes to those institutions that they have to necessarily identify the donation received, specific purpose donation and general purpose donation. Then the religious activity. We know the temple hundi collection. Say, today under service would be everything. But to levy the GST, something may be goods or service. Even though it is service, there should be a supply. Supply means there should be a quid pro quo. So anything where you find that there is a supply, only then you got to bring into the levy. However, there are some religious activities which are conducted in the temple beyond the hundi collections. Their other incomes are under the levy. Now, if it is a community hall, 10,000 rupees. If it is a shop, 10,000 per month. So they have given, and one has to fulfill this condition. The only issue that would come up here is, how do you identify this is a religious place and it is done as a religious ceremony? Because today you will also find a lot of trust that have come up in the name of temple. So someone has to also carefully apply, because the religious activity and the religious thing is per se not completely defined. This is one area where the issues would crop up. Business transfer. We also saw the judgment in the High Court, where when the business itself is transferred, that is itself is not a supply. However, they said, as a going concern, if a business is transferred, if it is either independent or whole part of it, it is outside the levy. So service tax was also exempted, even GST it is also exempt. Now, this, how do we apply in case of an insolvency? Today, recently we got in case of an insolvency, both IRP and RP are made to make a separate registration. And of course, with the notification 39, they said if it is a business which is continuing, you don't need to have separate registration. Now, the issue is, whenever an RP, IRP is selling, their intention, they prepare a resolution plan to COC. On approval of the resolution plan, the business is transferred. The intention there is to revive the business. If it cannot be revived, then selling of the business. Now, can I apply this, the sale of the business here, and go for an exemption? What is the issue there? If there is only one person who is coming up and saying that, okay, fine, I will take over this business and run well and good, but I cannot find one person, then I am breaking the business assets into 2-3 categories. The logo, brand name, I am giving it to someone. The machinery parts, I am giving it to someone. Scrap, I am giving it to someone. Eventually, the business is sold. Then can I really apply it? Because the brand name is continued by someone, or the assets are being continued by someone. So the application of the exemption of this going concern in that category is very doubt and difficult in my view. Next category comes on medical services. Healthcare, medical services, we know it is exempt. The clinical establishment is defined. If anything fits under clinical establishment, it is exempt from the levy. But however, we have the Columbia version. Arjun, I didn't hear you.
Nothing, sir. You can continue.
Arjun?
Sir, hello, sir. I have not interrupted. You can continue. Hello.
Okay. Now, even though the medical supplies are being done and which is an exempt, they have also come up with inter-unit supplies or not medical supplies, and it is coming under tax levy, which is an issue. Then RWA, we know wherever an association where the mutuality concept is there, up to 7,500 rupees per month collection is exempt. Now the words up to is an interplay. In fact, in the initially said where there is also when there is a doubt, we have to give the doubt to the on the side of revenue. I can read this as a two-way. Up to 7,500 no levy. Beyond 7,500 there is a levy. Or the other way of saying is, if it is up to 7,500 only, it is exempt. Beyond 7,500, wholly is taxed. This needs a clarity, and the circular which is issued by the government said, if it is crossing 7,500, whole of it has to be taxed. So we also have to read from the government perspective when they said that it is whole of it is taxed. So we have to be careful if someone is applying an interpretation up to 7,500 is being taxed. So we have looked at in the single residential unit case and the long-term lease. Yeah, we have looked at it. So some of the important judgments. I have another 5 minutes before I hand it over to Vasanth sir. In case of the Torrent Power Limited, they have looked at the electricity rent has the rental charges, testing, labor charges, certain things. So it is broken, and they said only distribution is exempt, so rest to be taxed. So then they said no, it is activity involved in the distribution and it is exempted. So what is now taxed by the electricity department is only the meters which are given. Leaving the meter, it is exempt. Then in case of Gujarat Cooperative Milk, now there is a situation where I sell the milk as such, then I also sell chilled milk. Now, can the status of chilled milk be same as the milk? That when it came, see, the chilling of milk doesn't alter the essential characteristic. I am chilling for if I have to store, I have to chill. So this means it is as good as a exemption is available to it. Then in case of Mantana Satyanarayana Raju, very famous in the South India, there are various therapies and everything which is being provided by him. Now they said this is not a medical the thing, it has to be taxed. So they have also extended naturopathy also as a system of recognized medicine, and even the services which are given in all these things would also be falling under the tax. Next, training and coaching provided by the appellant and intermediary colleges, it is treated as a composite and integrated course. See, most of the times when we see even in the colleges, they bring the CA coaching as an integral part of their graduation or the intermediate coaching. So that cannot be split. If someone is providing as a part of it, it is integral to it, and the exemption would be applicable to those services. Then in case of maximum tubes company, there are certain pre-import conditions which have been laid down, and by way of the notification 33 by 2015, wherein they said that the advance authorization scheme which is concerned in foreign trade also provides these conditions and benefits. So whenever these things are given, so that is where in the initial exemption which I have said, there are supplies which there are the exemption conditions which have to be fulfilled before supply or after supply. Now suddenly when something changes in the law, because the law keeps changing. When suddenly something is changing in the law saying that okay, these are the things you have to follow before you are importing, these conditions, whenever there is a change in the law, it cannot suddenly become retrospective and say you did not fulfill in the past and the exemptions would be withdrawn. So that is where I have said exemption notification should always be given prospective, not retrospectively, unless otherwise which is said. So these are the various judge laws, important judgments which I could cover. And the intention is to bring the various dimensions of the impact of the exemption applications. So this is the end of my presentation. I did exceed some of the time of Vasanth sir. Vasanth sir, over to you for your views and anything which you want to add it.
Hello, am I audible?
Yes, sir, you are audible.
Yeah,
Yes, sir.
very good morning to everybody. Thank you, Mr. Venugopal Gella. You have covered the exemption very exhaustively. There is nothing much to talk about whatever you have covered. I would like to add or I would like to mention few points here. First thing is if there is any exemption entry for particular transaction, it need not be understood as it was liable to tax or it was taxable transaction. Since exemption is given, it is exempted from levy. As a matter of abundant precaution, it could have been added to that particular transaction would have been added to the exemption notification, so that there should not be any confusion. For example, if you look at section 17(3), wherein it says value of land and building need to be included for the as exempted supply for the purpose of computation of reversal of ITC, as well as even if you look at the interest on deposits, now it is exempt, but again the question comes, just because of exemption entry, whether it is exempt or it is a taxable supply per se. So there are certain such entries wherein it is exempted, it is included in the exemption notification, but not necessarily it is a taxable supply. Now, and then the second thing is we need to understand certain terms used in the exemption entries to understand the scope of the exemption. For example, certain entries may start with by way of. When it is said by way of, the scope of entry is always restricted based on the legal precedents and also the meaning of certain terms. We cannot expand the meaning. If the exemption entry starts with the word in relation to, then it expands the meaning. You can give you can cover some more activities within that particular entry. So these are the things which need to be considered at the time of interpretation of the exemption entry. Then next thing is when an exemption comes with a condition, then it is up to the assessee whether to opt it or not. If it is unconditional, there is no condition attached to it, it is mandatory for the taxpayer to avail the exemption. He cannot pay tax on that. Then the next thing is the reference to FM speech, minutes of the GST Council, etc. Based on such things, definitely, as Mr. Venugopal Gella said, exemption cannot be availed. It is not part of the law. However, for interpretation of the intent of the legislature, these things may be considered while interpreting the statute. Court may also sometimes refer to the finance speech. It is said like this, finance minister speech or any other reference to interpret the particular intention. This may be useful, but it will not have any legal force. It may have some persuasive value. Next thing is consignment note with regard to GTA versus GTO. Consignment means it's specified what are the content it should be, but it's a legal document. It is a document for receipt of goods. The GTA gives the consignment gives the consignment note and accept the goods as a bailee. he takes the goods as a custody of the goods for a specific performance. So it has a legal meaning, and it's a legal document. Thereby, he assumes the custody of the goods for a specific performance. If something goes wrong with the goods, then he only would be responsible. There's a reason that consignment note is differentiated from the ordinary bill or any document issued by the transporter. So in the absence of consignment note, for example, per se he is a GTA, but he has not issued the consignment note in particular transaction. Thereby, the taxpayer has not paid the tax under reverse charge mechanism. In that case, the tribunal, I don't remember the tribunal decision. Here it is mentioned, it is the duty of the GTA to issue the consignment note. In the absence of the consignment note, the recipient need not pay tax on that. It was pertaining to service tax issue. So issue of consignment note is very important in case of GTA. Next thing is where any exemption is subject to the condition that input tax credit should not be taken. In that case, if by any chance the taxpayer had taken the input tax credit and subsequently he has reversed it, in such case also it is amounting to not taking the input tax credit. We can refer to Bombay Dyeing and Manufacturing Company Limited case, and also Pre-Court Meridian Limited case. Supreme Court has clarified this. Reversal of ITC is as good as ITC not taken. Then one more point is with regard to charitable activities. See, in case of charitable activities, who are performing the activity which is specified to be a charitable activity in the exemption notification, in addition to that, they may also engage in selling the religious CD or books or something like that, or some other goods. Then whether such activity is amounting to business or such activity is liable for GST. There are some AARs. The one which I can refer is Srimad Rajchandra Adhyatmik something Samsthan something, Mumbai AAR it is. In that case, it is said it is in the nature of business. Such activities are in the nature of business, well covered under the definition of business. Hence, it is liable for GST. Whereas we must understand, in case of Sai Publication Fund, Honorable Supreme Court has clarified where the main activity is exempt or where the main activity is charitable activity, then any incidental or ancillary activity cannot be a charitable activity. So that activity has to be given the same treatment as the main activity. The principle of this particular decision, or there are many such decisions, should be equally applicable even in GST also, where one cannot be single out that ancillary or other connected activities when main activity itself is a charitable activity. Then one more thing what I can add is concept of mutuality with regard to Resident Welfare Association. Recently, Supreme Court, in the case of Kolkata Club, it held that in case of members club, concept of mutuality is applicable and the service tax is not applicable on the monthly subscription. This concept should be equally applicable even in GST also. So wherever the member club provides any service to its members, if it is providing any service to outsider, of course, yes, it is liable for GST. It amounts to supply. But when the service is restricted only to members, then it is not a supply, because there has to be a supplier and the recipient. Then only there can be a supply. Whereas in case of members club, there is no two different entities. members and the members club is one and the same. This is what the concept of mutuality is. So that principle should be applicable in GST also. This is what I thought I could mention. Now, can we take up the questions, Arjun?
Yes, sir. Sir, thank you for providing value additions to the deliberation made by Venugopal sir. Now we can head towards question and answer session. So Venu sir, I will be reading the questions for you. You can answer, sir. Shall I start?
Yes, Arjun.
Yes, sir. Sir, the first query related to our session. Sir, in GST, there has been two terms defined like nil rated and exempt supply. How we can differentiate these two terms, sir? What is the reason or intention of the government behind that, giving two different terms like nil rated and exempt supply?
Okay. So if you look at the definition of the exempt supply, it starts with, it means supplies are attracting nil rate of tax and also supplies which are wholly exempt from tax. If you look at the entry number 11, where there are which is rate notification for services, there are 4 supplies where the rate of tax is nil. Now, eventually whether it is nil or wholly exempt is one and the same. But however, they as I said, they, to give an abundant caution, they would want to cover both. But is there any technical difference between nil and wholly exempt? If both the treatment of nil and wholly exempt is one and the same from the ITC reversal perspective, etc.
Okay. Vasant sir, can you add up anything?
Yeah, see, if you look at the Central Excise Exemption Notification, Central Excise Tariff Act, as well as Custom Tariff Act, in the Tariff Act itself, rates specified with respect to certain goods are nil rated. Earlier, such entries were called to be nil rated goods. So nil rated is also tax rate specified in the exemption or in the tariff. Since it is mentioned in the tariff, it's a rate. That's what it used to be interpreted earlier. So same thing is carried forward now also, but hardly any entries in the rate notification which is subjected to nil rate. But as Mr. Venugopal said, there is technically there is no difference between nil rated and exempted. It is one and the same.
Okay, thank you. Sir, moving on to next query. Sir, whether the government has power to give exemption with retrospective effect? If so, which are all the situations or how, when one can interpret an exemption entry with retrospective effect?
There is, whenever the thing, in fact, I have mentioned in one case, the government, I will remember the notification number, the exemption, they said this is retrospective. Like, let us take a simple example. We all know rice is exempt, but there is a, let us say there is a one different category of rice. Now, the general purpose, we think that it is also rice, it is exempt. But for some reason, they have brought up an officer saying that no, it doesn't fit into this and this category of rice, because the HSN entries which are given are specific wordings. The government can say that no, this is also an exempt, and whenever that exemption they come in, they also have power to say that it is with effect from last 1 year. They can bring a new entries also as an exempt. So 11 subsection 3 specifically provides for this provision.
Okay, sir. Sir, can you give any, for example, if the notification does not provide any retrospective effect expressively, can a taxpayer interpret such exemption entry with retrospective effect?
I have given 3 case laws where they have interpreted with retrospective, but I said it is also to be read as an exceptional circumstances. By applying the doctrine of fairness, the courts have given this retrospective exemption, saying it like these two products are there like similar akin. then they have taken the quotes on a retrospective. But generally, as a thumb rule, effective date of notification is from the date in which it has been notified.
Okay. Okay. Sir, moving on to next query. Sir, as we said, for example, rice presently, generally rice is exempted from GST. However, when it is being sold under a brand, the exemption is not available. We need to pay tax. So now, running a supermarket, whatever rice being purchased, it will be packed in the packet with the name of that supermarket. Will it amount to be a brand, or can I still avail the exemption even for such sales?
Yeah, so if it is any rice tagged under that supermarket, it is an unbranded. But this is a branded store, only my products are sold. Let's say more mega supermarket, more supermarket, all these things, where they sell their own products also. When their products are being sold under their brand name, then it becomes a brand. And unless otherwise they have relinquished the word, say more, the word usage of the more is relinquished as a brand, but it is merely used in the logos, then it can be treated as unbranded. But in a supermarket, which is an branded store, where that brand of the supermarket is registered, it becomes a branded product.
Okay, sir. Vasanth sir, anything to add up?
Yeah, here only the distinction what we need to understand is the house mark and the brand name. House mark is connected to the manufacturer or the brand owner, whereas brand name is connected to particular product. If anything which is connecting to the product, then we can say it is a branded product. So yeah, that is the important differentiation we should be able to understand. And also in every case, the manifestation of the brand on the product is not necessary. As Mr. Venugopal mentioned, the circumstances in which it is being sold, that also makes a lot of difference whether it is branded. If it is a single branded outlet, then the goods sold from that outlet will have the color of the branded goods, though the brand name is not manifested on the product itself. So this differentiation we should be able to understand to see whether it is a branded product or not.
Sir, moving on to next query. Sir, under composite supply definition, it is said that there should be two or more taxable supplies, where one of the supply is principal supply. In my case, I am supplying one taxable and one exempt supply, and the taxable supply, exempt supply is principal supply. Can I construe such bundled service, which includes both taxable supply and exempt supply, as a composite supply?
Yes, sir. Very much. Section 8,
Yes.
the whole of the supply would be treated as if it is a supply of principal supply. So even the taxable supply HSN is also like the principal supplies HSN, then it becomes a exempt supply.
And the context of the main context of that query was, for example, I am running a hospital. Along with the hospital, I am providing that healthcare services. For example, so it is exempted. Along with such healthcare services, I am supplying the medicines also, which are taxable. So here the combination is both exempt supply and taxable supply. Can this be construed as a composite supply? Is the query, because the composite supply definition says it has to be either two or more taxable supply. Whether in exempt supply can be included within the ambit of taxable supply. This is the query of main portion of the query.
Yeah, in my view, yes, Vasanth sir, if you want to add anything.
I also agree to this. Here, the principal supply being the healthcare services, then which is exempted, then anything being done along with that, because we cannot say simply it includes here. It is very difficult to say how many supplies are there. We cannot say only the healthcare service itself involves so many things, including the room rent and various other charges are also included. So these all are room rent per se is taxable. It is not healthcare service, but it is given as a part of the healthcare services. The healthcare service being the principal supply, room rent also will get exempted. Similarly, food. So all these things we need to consider. If there are only two suppliers strictly, let us take some example wherein only two suppliers are involved. One of that is exempt and one is taxable. Then whether it becomes a composite supply or not, that is a question. If you look at the definition of composite supply, it should there has to be two or more taxable supplies. Then again, if you come back,
Yes, sir.
whether it is a taxable supply and exempt by the notification, then you may also say
Yes, sir.
the exempt supplies includes taxable supplies includes exempt supplies, so exempt supply includes taxable supplies. So these are the various interpretations possible. So there should not be any issue to interpret that where strictly in the hypothetical example, two supplies, one is exempt, one is taxable. In that case also we may assume it is a composite supply.
It can be composite. Yes,
Arjun.
sir. And one more thing, sir. Yes, sir.
Arjun, I think
Yeah.
there is
Yes, sir.
a little gap in the question and answer. The question
Yes, sir.
I think is coming from the definition of composite supply in 2(30), where they say that two or more taxable supplies. So the answer to
Yes, sir.
that is taxable supply. What they have mentioned is that whether it is exempt or it is nil rated, it is still a taxable supply. The answer to the query is that what 230 says, every taxable supply means any supply which is liable to tax, and any of these supplies, whether it is healthcare service or anything else which are exempted or nil rated, they would still be covered in taxable supply. So the confusion has been created because of the use of the word taxable supply. So taxable supply includes exempt and nil rated supply is the answer. Please go ahead.
Okay, sir. Okay, sir. Sir, moving on to next query. Sir, I am renting out a commercial property. So along with the rent, I would collect as a reimbursement of this electricity charges and water charges. Electricity as a goods per se, it is exempted. So while collecting as a reimbursement from the tenant, can I still claim the exemption, or I would require to collect tax on such electricity charges?
Vasanth sir? Yeah. So here when the question, it is again a litigative aspect, but the department has taken a view when you are collecting the electricity charges, water charges separately, it is still an independent supply, and that has to be tested separately. The next thing, even for the purpose of RWA, they have said it has to be included and considered for the purpose of 7,500 calculation. Then lastly, in case of a commercial renting, the common area maintenance, even if they put separate meter and they say that meter electricity is collected, the onus of proving that this exemption notification is on the provider of the service supplier. Now, if I am collecting the electricity charges would come outside the purview of the levy. But am I collecting it as an electricity charges as such by way of the meter, or I am doing an ad hoc calculation and saying so much towards electricity, so much towards water? In that case, proving that it is electricity supply, water supply, it becomes a challenge. Otherwise, it is an exempt supply.
Vasanth sir, anything to be added upon?
No, I agree with that.
Okay, sir.
I'll add something on this also. See, the electricity which is there, what I will say, what basic Venugopal said was correct. It is like this. When I have a separate meter, I have one commercial place which I have given, and I have a separate meter for each of my building or each of the floors which I have let out to different people. If so, I am just an agent of the other person collecting that amount which is being paid to the local BESCOMs or whichever electricity company. In such a case, there would be no question of adding electricity to the rental amount. However, in many of the cases, like Venu said, there are cases where there is something more collected. There is an allocation done, and in that allocation, some transmission loss is added, and after that, the cost is allocated to everybody. Where this cost allocation is there, or a lump sum amount, some amount is fixed per unit so and so. If there's such a amount is fixed and collected, then I think it could be said to be part of the commercial rent itself. Of course, if it is residence, then this works better for a person, because if it is part of the residence, then there is no question of liability. Yeah. Next.
Sir, next query. That's the supply to SC set, zero rated supply. Whether the zero rated supply can be considered as a nil rated supply.
Zero rated supply is not a nil rated supply. The rate of tax exists for that product, but it is made to zero. That is how one have to look at the zero rated supply as. So it is at par with a taxable supply. It is not an exempted supply or not a nil rated supply.
Moving on to next query. Sir, it is related to healthcare services, hospital. Sir, presently I am claiming the exemption under healthcare services for the supply made through the hospital. While providing such healthcare services, I am supplying medicines within MRP. So can one say that when I am collecting the price under MRP, the taxes are included in that one? So whether the department can raise an issue to pay back the taxes collected for such medicines? Is it possible to do that? Vasant sir, I'm audible?
Now in GST, yeah. Hello.
Yes, sir. Yeah.
Okay.
In GST, there is no concept of MRP based valuation. The GST is paid even on medicine on transaction value only. Mentioning MRP on the product is the mandatory as per drug price control order. That's why it is mentioned. Earlier under excise, the excise duty was paid based on the retail sale price minus abatement. On that value, excise duty was paid. And subsequently, any number of time when it is sold, there was no question of again levying the excise duty, because only once the levy arises in central excise. Whereas in GST, it is multiple levy. Every time whenever sale or supply happens, GST is to be paid on the transaction value. So here you cannot say that since tax is paid on MRP in case of medicine also in GST.
Okay. So just because I am collecting at the MRP rate does not means that I am collecting GST.
Correct.
Yeah. Okay.
I think Arjun, I think there is some depth in this question asked by this gentleman or lady.
Okay, sir. Yes, sir.
So I think the question is like this: though I am providing inpatient service, I am collecting separate line items. For the treatment, I am having one line item. For the various items like your rental for room, everything is a line item. In those line items, I also am collecting, say, 100 rupees MRP for a particular tablet.
Okay.
But this particular tablet, when that hospital is purchasing, they are purchasing only at say 60 rupees. And they have paid whatever 12% or 18% on that, which may be 10 rupees. So 60 plus 10 is what they paid for, but now they are collecting 100 rupees for that medicine. Will that have any impact is the question. So the answer to this is that you have to first find out whether what is it that is, whether it will fall under composite supply. That's all the question you have to do. Whether you put bed 10,000 rupees and for treatment 1,000 rupees doesn't make a difference, because what is the composite supply? Is it a composite supply? Composite, yes, it is a healthcare supply. It was for treatment of something. Then within that treatment, if you are charging somewhere more or less, there may not be any impact. However, department may try to say that there is a unjust profit made by that hospital because it has purchased at 60 and 10 and it is selling at 100, and in that 100 there may be around 4 or 5 rupees of GST also involved. Indirectly you are collecting GST. That is what the department may say. I feel the dispute can be there, but there may not be any issue because the basic point is that it's a composite service. Yeah, next question. Arjun?
Yes, sir. Yes, sir. Sorry, I was under mute wrongly. Apologies for that. Sir, Venugopal sir got some technical issues. He will be rejoining. By the meantime, I will raise the queries and you can answer, sir. You and Vasanth sir can answer. Shall I continue, sir? Hello?
Yeah,
Yes,
continue.
sir. Yes, sir. Sir, under GST, renting of residential dwelling for residential purpose is exempted. So now there is a concept of this providing PG services like to students as a hostel. So presently we are providing the PG services and the food is provided as an optional. Can we claim the exemption of residential dwelling rented for residential purpose for this PG services and hostel services? Vasanth sir?
Yeah, if you look at the description of residential dwelling in education guide, the exclusion has excluded hostel. Hostel is because the amount of or duration of stay in hostel is equivalent to the residential use. This is what has been assumed in the education guide, whereas the guest house and hotel or inn or certain other activities are excluded from this exemption, whereas a hostel eligibility is there. But again, the question here is along with the hostel, food is also provided.
Yes,
then it becomes a composite supply. In my view, when a residential premise is given for hostel purpose, exemption should be applicable. Madhukar sir?
Yes.
Yeah, I think I'll agree with you for 2-3 reasons. First of all, education guide is not valid for in service tax law itself, because the education guide starts with saying that you cannot use it for any litigation.
Yeah, departments only has disowned it.
Yeah, for in service tax regime itself, education, and you can't pull it to GST. Second, here they have not put any restriction. They say for residential purpose. So residential purpose does not mean that you have a full-fledged kitchen, drawing room, dining room and all that. Residence purpose means where you can come and sleep. With the advancement of life, there are many places where residences don't even have a heating item, because everything comes from Swiggy, and they just come, sleep, get up, go, have a bath and go. So there are a lot of have happened in the environment, and I will agree with Vasanth that possibly a PG would be said to be used for residential purpose, and there will be liability on the PG. Now the question is whether food is added to, can be said to be a composite part of the residence. In normal course, it is not. In a hotel, when they serve breakfast, bed with breakfast, that is naturally bundled. But if you look at PG with food, may or may not be naturally bundled. I don't know. If you say it is naturally bundled, then of course it will also be exempted. That's what I think. And also, one more point, even if it is not considered as residential dwelling, a PG less than 1,000 rupees per day can also, possibly get that second exemption of less than 1,000 rupees a day.
Okay, sir. Sir, while calculating that 1,000 per day, we need to go by the building price or bed wise for this PG.
It is building wise. This is what recently in one of the AR, I suppose, that has been clarified. It is though ARs are not really of great use, but here it is said that whatever amount is mentioned, that is not for the bed, it is for the premises or that place. That is what is clarified.
Okay. Okay. Sir, moving on to next query. Sir, this is relating to both exemption entries and also prevalently related to real estate. Sir, under real estate recent notification amendments, they have said that all the developers should procure 80% of his inward supplies from a registered person. So, for example, I have procured a loan from an unregistered person, from an individual. Since it is an exempted supply, he has not taken registration. So, will such interest amount will be considered for the total procurement for the purpose of calculating this 80%? This is the question.
Yeah, in my view, for considering the or for computing the 80% limit, this all supplies need to be considered, including this interest. But indirectly, you should not compute the tax on the interest portion also. For example, all your supplies from the registered person is say 78%, and 22% is the interest. Say in the initial year, it is possible that the interest portion is more. In that case, all other purchases are from the registered person only. The only unregistered supply from unregistered person is interest. In that case, to reach 80%, you should not pay interest on this exempt supply. That is on you should not pay GST on this interest, because whatever cannot be done directly, it cannot be done indirectly also. When it is exempted, you cannot tax it indirectly.
Okay, sir.
I think what Arjun you can do is you can give
sir.
a you can study it and give a much more what I would say considered answer. I think there are some little more depth we may have to examine that. So we can
So this
them
query will
and
be
give
taken up offline. Okay, sir.
Yeah. Not offline. You tell everybody, but tell them after the study, pass it through Vasanth and then.
Okay, sir. So this query will be reserved and will be answered later. Sir, moving on to next query. Sir, for the purpose of calculating my exempted supply turnover, for example, I am providing exempt supply. During the course of providing such exempt supply, I am also collecting some charge as a pure agent, collecting such some amount from the recipient as a pure agent. Whether to include the pure agent within the value of exempt supply, or it will not form part of my turnover.
In my view, amount collected as pure agent will not form part of value, so it should be excluded.
Correct. Yes, it should be excluded.
Okay, sir. Sir, moving on to next query. This is not exactly related to the exemption portion. Shall I ask, sir? It is relating to some rate condition, rate of tax condition. Can we take up this one, or we will take it offline, sir? The query is like this.
Time permits you can take.
Yes, sir. The query is in relation to restaurant service and real estate services, there is a condition to not take input tax credit without giving any alternate option of rate of tax. Sir, is it legally valid?
This aspect has been discussed yesterday.
Yes, sir.
Whether rate notification can be subjected to any condition. But if you look at the notification, that is notification 12, that is issued taking powers from section 9, 11, 15, and also 16. That way,
Yes, sir.
department may say the relevant authority is there to issue the notification, rate notification, along with conditions attached to it. So this is there is no precedent for this, because if you look at the earlier tax regime, the rate was mentioned or defined in a separate act, tariff act, and the exemption tariff act itself was giving authority to change the rate also. And exemption, there was a specific provisions in the act, and under that provisions, the exemption notifications were issued, maybe subject to certain conditions or without conditions. Here, the new method has been followed by the government, wherein in the rate notification itself, conditions are being attached. Section 11 says if it is unconditional, then only it is mandatory. Whereas the rate notifications here, it gives partial exemption with conditions, which is also mandatory. So there is a contradictory treatment in the rate notification.
Okay, sir. Now I will put it up.
I think in the earlier sessions, Arjun, in the first few sessions, I think this particular matter was made clear.
Yes,
That, these type of possible, where they have given a mandatory rate and they have also given conditions. Legally, this is not valid and it is going to be challenged, and it will be found. The court possibly will say that a person has an option to go under the earlier scheme of availing ITC. So I think that was the question which was asked, and I think question has arisen out of some of the thought process of that levy section, where there some questions were there on that. The answer is that it is possible to be fought, but remember that when we are learning the subject, whatever we are learning about what can be defended or fought is going to be used only where we have clients who are not followed. In normal course, we will say that please follow the law to avoid any dispute, because all disputes will go higher and higher, especially real estate. This particular aspect which is there will go, it will go to the High Court, then High Court will possibly rule in favor, and then they will try to make some retrospective amendment and also appeal to the Supreme Court. Once it goes to Supreme Court, 10 years is over. Therefore, you have to be very careful in taking this advice, while you should know that it is invalid. Maybe if you are trying to comply, don't fight it, comply. If you get into trouble, departmental, I mean, there is a notice against you, then all that can be used. Please go ahead.
I would like to add one thing here. Recently,
Yes,
Gujarat High Court, in the case of Mohit Minerals, while deciding the tax under ASEM on ocean freight, categorically held this rate notification number 8 under IGST is ultra virus, since it lacks legislative competence. There, all these aspects are discussed, and it said a rate notification cannot be subjected to conditions, and also it is the duty of the parliament to prescribe the rate and describe the goods and services which they intend to tax. That authority has not been delegated nor it can be delegated. It is the duty of the parliament. Parliament alone has to pass an act for the rate and the tariff. This is what is the principle followed in that judgment. Hope Supreme Court also would do the same. Then the recourse to the government is to go for their favorite thing of retrospective amendment.
Okay. Okay, sir. Moving on to the last query for the session relating to exemption, sir. So this is related to a case study. In the context of the decision by Gujarat High Court in the case of Gujarat Milk Producers Association case, the query is that the milk is exempted from GST, sir. When the milk is a preservative in nature, that means packed and can be stored for 6 months without refrigeration. Can it still be considered as a normal milk and claim exemption, or we need to pay tax for such preserved milk?
Arjun, in between, I was unable to hear you. Can you repeat the question?
Yes. Yes, sir. So the question is in the context of the case of Gujarat Milk Producers Association. So in context of that case law, the query is that, sir, normal milk is exempted from GST. Now we are producing a special milk which can be preserved and stored for 6 months without refrigeration. Can we claim the same exemption of a normal milk to our special preserved milk?
In my view, so long as it is milk,
Yes,
I
sir.
need to see the exact entry for exemption in the milk, whether it is, if it is simply said as a milk or unprocessed or some conditions are there, then matter is different. If it is only a milk, since here also character is not changing by processing, then the exemption should be applicable. Madhukar sir?
Yeah, it is 4.04, and I think the description, if I remember correctly, is milk only. So my answer is whether you process it or flavor it. In fact, there are some decisions in ARs saying that flavored milk is at 12% or something. But I am of the firm opinion that it is milk only, and milk is at nil rated, 4.04. Whether you preserve it, you chill it, or you add a little flavor, because that flavor, the milk is still a milk. It is flavored milk, that's all. And therefore, under all the old case laws which we can think of, it would come there only. There is also a decision, I think this Gujarat decision only is in his favor, if I am not mistaken.
Yes, sir.
That was on flavored milk only, if I am not mistaken. So it will be preserved milk also will be 4 only and exempted.
Okay, sir. Okay. Sir, by this we have addressed all the queries relating to the exemptions session. Thank you, Madhukar sir and Vasanth sir, for your clarification for the queries raised by the participants. And I thank Venugopal sir. Presently, he is not online. He left because of connectivity issue. I thank all the participants who listened patiently for the deliberation and also the clarification provided by the experts for your queries. By this, we have come to the end of first session. We may break up for next 20 minutes, and we will connect back by 11:40 with the next speaker on the session, unresolved issues on input tax credit. Thank you. Thank you, sir.
Thank you.
I am not able to share that immediately. You take it from website itself. No problem. Arjun? Hello? Arjun, you are there? Arjun? Arjun, you are there? That, my voice is not audible, is it? Hello? No, now? Hello? Okay. Hello. Arjun? Hello. Hello. Arjun, am I audible? Arjun, audio? Can you hear me? Okay. I think I have done. Yes, yes. When I'm talking, it is moving, na? Can you check with this other one, Divya? Who else is there?
Sir, am I audible through now? Through the
Now
system now?
I am audible. 1 minute, wait. I will mute 1 minute. Arjun, am I audible? Arjun?
No, sir. Still
No.
couldn't hear.
What should I do now?
Just a minute. I'm trying any other way option. Audio.
When I'm talking, the speaker is moving. The volume, this thing is moving. Arjun?
You're audible now. You're audible now, sir.
What happened
Yes, sir.
earlier?
What happened? I think from my system, I have muted you or some other technical issue.
Now you can hear me, right?
Yes, sir.
Okay. Now is it clear, Arjun? Hello? Hello?
Yes, sir. You're audible now.
Okay.
You're audible.
Okay. So
We have
presentation.
once I start the session, I will send you the notification for sharing the screen, sir. Then you can share.
Okay. Rupa is joined.
She will join the due course. She is not joined right now.
Okay.
She will be joining by 12.
12. Okay. So for me to share the screen, should I select any option or you will do it?
I have made you presenter, sir. Now you have got a notification now to show.
So I will put show my screen. Session is starting, or
no,
okay, you will.
No, don't select the show your screen. Near your screen, there will be a download arrow. Click on that drop down and select the PDF. Only the PPT you need to. Yeah. Yes, sir. You can select now.
I have selected.
Yeah, it is visible now. Your PPT is. Both your PPT and video are.
Hello.
Yeah, ROOPA madam has joined. I will start now, sir. Welcome back to all participants of this advanced certification course. Now we will resume to the second session of the third day of our certification course. We should be taken up by CA Vikram Kataria on the topic Unresolved Issues on Input Tax Credit along with landmark decisions in under GST regime and S12 regime. As I informed earlier, the scheduled session was valuation. Due to unavoidable reason, we have rescheduled the valuation session to next week, and tomorrow's input tax session has been preponed to today. I would thank especially Speaker Vikram sir for accepting such preponed session. Now moving on to introduction of the speaker. CA Vikram Kataria is a qualified chartered accountant in the year 2010 and he is also a commerce graduate from Loyola College, Chennai. He has vast experience in indirect taxes, working in a Big Four, and currently he is a partner of Hirange Associates, heading the Chennai branch. He had led the task of smooth transition to GST for renowned corporate clients in the field of IT, healthcare, automobile, sugar, NBFC, and petrochemicals. He has co-authored the book on new and simplified returns under GST. He had also contributed to the handbook on annual return and audit under GST, which was published by Swastik's publication. He is also a regular speaker at various seminars and corporate tax forums on GST related matters. With this brief introduction, I would warmly welcome today's speaker, CA Vikram sir. Sir, welcome.
Yeah. Thank you, Arjun.
Sir, in addition to the speaker, we have expert who would be adding up the value after the deliberation by the speaker. The expert for today's session will be CA ROOPA NAYAK. With regard to introduction to the expert, CA ROOPA NAYAK is a qualified chartered accountant in the year 2008, and she is partner in Hirange Associates, heading up the consultancy wing in Bangalore branch. She has co-authored several books like Central Excise Made Simple, the background material of certification course on indirect taxes, and 2-3 days workshops on enabling service tax practice and first cut background material on GST. She has also co-authored students handbook on indirect taxes handbook on CST. She's an active contributor of articles online to CA Club LinkedIn for 7 years and to various professional institutes such as ICAI. She's an active speaker in seminars organized by branches of ICAI and chapters of ICAI, also study circles. With this brief introduction, I would warmly welcome the expert for today's session. Welcome, Roopa Madam. By this, I would hand over the session to speaker for the topic CA Vikram sir to take it up. Sir, you can take it forward.
Yeah, thank you, Arjun, for the introduction. Hope I'm audible.
Yes, sir.
Okay. So firstly, I would like to thank Hiragangi Academy to give me the opportunity to present and share my views on one of the most interesting topics in the GST law, which is input tax credit. So undoubtedly, in my view, probably one of the sections or one of the aspects which has been the highly read, which has been highly read by all professionals and industry people, would be this input tax credit covering section 16 and section 16 primarily. So the topic for the day is only on section 16. Section 17 will be dealt by Shilpi Jain tomorrow, and she will guide you on terms of the various restrictions and the aspects with regard to the common credits. So the session for the day is very specific on section 16. So we will be looking at the critical aspects which are to be dealt with in the section 16. Rather, I'll put it in this way, that we will not be looking at the verbatim of the said section, but we will be looking at the issues or the key elements which one has to understand to interpret the significance and the importance of the said term. So when I start the session, when you look at the section 16.1, so as I said, I will not be going through the verbatim. The objective of this course is certainly to look at the next level issues and not to look at the basic issues. So when we are looking at section 16, so my session today will broadly cover 4 key elements with regard to the eligibility of credit. So the first element which we will be discussing upon is the term entitled. So when you look at the section 16.1, it says the registered person shall be entitled to take credit of input tax on goods or services. So when we look at the term entitled, it has a much wider and a much significant value as compared to the erstwhile regime. So when we come to the discussion on entitlement, so I will guide you in terms of the jurisprudence and also the comparison with the erstwhile law. The second key element which we will be discussing in today's session is the aspect on the intention of use. So the said provision gives the requirement that the input or input services or the goods or services shall be used or which are intended to be used. So there is a much wider implication for the term intention to use. So that also we will be covering in the session. The third element is the aspect of the use in the course or furtherance of his business. So again, here there is a lot of relevance and importance to the term course or furtherance of his business. So all these aspects we will be referring to various jurisprudence which have been dealt in the erstwhile law, and also some relevance in terms of the judgments which have come under the GST regime also. The final aspect is with regard to the conditions and restrictions which have been provided in the said section. So generally there are a lot of discussions whether certain conditions are unreasonable, whether the restrictions is unreasonable. So all these questions have arisen, have been a subject matter of discussion for a number of times. So let us try to decipher what is the importance and the significance, and whether it is a valid condition or a valid restriction which has been imposed by the legislature. So when we look at the term shall be entitled, which is the first aspect which we will be discussing in today's session. So if I look, I make a comparison with the erstwhile law. Say for example, the CENVAT credit. So the CENVAT credit rule 3 provided that the credit shall be allowed. So it allowed a credit. So it was not an entitlement, but it allowed a credit of the taxes paid, the specified taxes paid. Vis-a-vis, if I look at the VAT regime, so if I look at specifically say Tamil Nadu VAT as an example, so even there this input tax credit was more of a concession where it was a deduction towards output liability, So even there they use the word it shall be allowed. But interestingly, under GST they have used the word entitled and have not used the word allowed. So what does the term entitled mean? Is there a significance or a much wider relevance when we look at the GST? So in this aspect, if you look at three key terms, so these terms are not defined in the GST law. So we are looking at the general definitions which are available with regard to these three terms. So the first term which I would be discussing is the vested right. So if you look at the various dictionary meanings, vested right means an absolute or an indefeasible right. So generally we say it is my constitutional right, it is my vested right, you cannot impose any condition, like right to speech, it's a vested right. So vested right, if I have to simply put, it is a right which is available to you and there cannot be any conditions or restriction imposed on such right wherein this right has been taken away from you. So it is more of a permanent right which is available to you. With regard to a tax law, if I look at the concept of a benefit, and that is what has been generally held in the context of a VAT law or to some extent in the erstwhile law, the benefit in the context of a tax law is that it is a concession. So please note, it is a concession allowed under the law which is subjected to certain conditions and restrictions. So a benefit, it is just merely a concession which the lawmakers have provided, but the requirement is that you have to fulfill the conditions and the restrictions. So when I come to the third element, which is an accrued right, so I would probably say an accrued right flows from a benefit, wherein once I fulfill or satisfy all the conditions and restrictions which are provided in the legislature for the benefit which I am entitled to avail, so then it becomes an accrued right. So accrued right means a matured right or a right that is ripe for enforcement. So probably benefit is a concession, but once I satisfy or fulfill the conditions and restrictions of the benefit, it becomes an accrued right. So there cannot be any other means by which the said right can be taken away unless I have not fulfilled the conditions or I have not satisfied the restrictions which are provided in the law. So in this background, so fundamentally if I have to look at the inception of this GST by itself, so this Constitution Amendment Bill 2014, so which was the 122nd Constitution Amendment Bill, so which was presented, and that paved the way for the 101st Constitution Amendment Act, which introduced the GST law in India. So the statement of objects and the reasons for this bill, which was part of the said bill, because when the lawmakers want to introduce a bill, they have to give a background as to why the said bill has been introduced. So the one of the key objects or the reasons in the amendment bill was that this goods and services tax would replace a number of indirect taxes being levied by the union and state, and it is intended to remove the cascading effect of taxes and provide for a common national market for goods and services. So very clearly, even the government has introduced this law with an intention to remove the cascading effect. So I believe most of you would be aware that the cascading effect means to avoid tax becoming a cost in the hands of the person who is supplying the goods or services. So similarly, like in the erstwhile law, a trader could not take the credit of service tax and the excise duty charged by the manufacturer or the service provider. So in order to avoid the cascading effect and to enable the credit, the said law has been introduced. So the entitlement also can be drawn reference with the Constitution Amendment Bill, that it is also a constitutional mandate given by the legislature that you have to enable the credit in the hands of the taxpayer and to the extent possible avoid the cascading effect of taxes. Please note this is a very important aspect because it flows straight from the Constitution Amendment Bill and the Act. So now let us look at the issues per se. So as of now we have discussed the general understanding of the term entitled, which is either a benefit, and once it is a benefit and I satisfy the conditions, it becomes an accrued right. So now let us look at various jurisprudence with regard to the said context of the eligibility to take credit. So here in this case, this one of the landmark judgments, which was in the case of Jayam and Company. So the Supreme Court had a case before them with regard to this Tamil Nadu VAT Act. So briefly, if I could say, the facts are that the Tamil Nadu government had introduced this VAT law, and the section 19 of the VAT law provided the eligibility to take the credit. Also they provided the restrictions, various restrictions under which the credit was blocked or it was not eligible to the dealer. So this VAT law, which came in 2007, did not have much challenge, but in August 2010 the government introduced a new provision, which was section 19 subsection 20. So there the clear intention of the government was that if a dealer is purchasing goods at say for rupees 100 and he is selling the goods at a loss say at 80, the credit should be restricted only to the extent of rupees 80. So in summary, they wanted to restrict the credit in case the goods are sold at a loss. So the credit will have to be reversed to the extent the goods are sold at a loss. So for the 20 rupees loss, the dealer had to reverse proportionate credit. So this was the amendment, but the challenge in the amendment was that, as usual, now we are getting used to this retrospective amendment concept. The Tamil Nadu government had mentioned or had notified that the said provision will be applicable from the inception of the VAT law itself. So it became a retrospective amendment. So in this case, this assessee, which JM and Company, had challenged this amendment before the Supreme Court. So this matter went up to the Supreme Court. So interestingly, if you look at this judgment, many people, including the department, will generally refer to this judgment against the assessee. So whenever you say that credit is a vested right or it's an accrued right, department will take out this judgment against you, saying that I have a Supreme Court judgment, which is JM and Company, wherein if you look at the final ruling of the Supreme Court, the aspect which was covered was on two grounds. One is whether the introduction of the new restriction is a valid one. Second, whether it can be a retrospective amendment. So conveniently, the department may choose to look at only the first aspect and ignore the second one, because with regard to the first aspect, the Supreme Court has held that it is a trite law that whenever a concession is given by a statute or a notification, the condition thereof are to be strictly complied with in order to avail such concession. Thus, it is not the right of the dealers to get the benefit of ITC, but it is merely a concession granted by virtue of section 19. So don't be surprised if department will consider this judgment against you, because they feel it is in favor of the department that the credit has been held to be merely a concession and not a right. But please note, my friends, that the second aspect is much more important than the first aspect, because the Supreme Court has made a wonderful observation and a very good conclusion. So wherein we can draw reference to the aspect of a right being available to the assessee. So here the Supreme Court has held that the manner of calculation of input tax credit was different before this amendment. So prior to this amendment, there was no such restriction and it was clearly available to the assessee. This is clearly a provision which is made for the first time to the detriment of the dealer. So it is something introduced to deprive something in the hands of a dealer. Such a provision therefore cannot have a retrospective effect. More so, please note, cannot have a retrospective effect more so when vested right had accrued in favor of these dealers in respect of purchases and sales made prior to the said amendment date. So very interesting is that though the court has held that it is a concession, which department will take as a primary argument, what ground you have to take is that though they have held it to be a concession, once I have fulfilled the conditions or once the credit was taken at a point where no such restriction existed, so it becomes a vested right and that cannot be taken away. So we have to be careful whenever government makes a retrospective amendment or an amendment in the provision of the input tax credit, this particular judgment will certainly be in support of the assessee, because you have to look at the second element which was answered in favor of the assessee. Hence the retrospective amendment was struck down. So similarly, now if I look at one more Supreme Court larger bench decision, so this is again one of the celebrated judgments which many of the senior counsels will be discussing upon when you talk about a credit being a right or a benefit. So now in the case of this Daiichi Karkaria, so it is actually a case of valuation. So surprisingly, this is a matter on dispute with regard to valuation, but it has a very important observation or a ruling finding by the Supreme Court, which has a wider implication on the input tax credit. So here in this case, the case was a dispute on the valuation. If most of you are aware that in case the consideration is not the, or the price is not the sole consideration, and if the customer has provided certain goods to the supplier of service, then the value of such goods needs to be added to the consideration. So for the purpose of valuation, even under excise, under section 4 read with rule 6 of the valuation rules, the assessee was required to add the value of the goods which was provided by the customer. So it is similar to what we have even under GST. So in this case, the dispute was that, for example, the customer has purchased material for say 1 crore plus GST of 18 lakh. So 1 crore 18 lakh is the value of purchase by the customer, and the customer is providing the inputs to the service provider, which is not actually part of the service contract. So we will not go into the aspect of the job work valuation. So consider this to be added for the purpose of valuation. So in this case, the department made an argument that the value which has to be added for the purpose of levy is the consideration charged by the service provider plus 1 crore 18 lakh rupees. So they had added the value of the tax or the duty paid by the customer, which was available to the customer as a credit. So for this simple question, this matter went up to the Supreme Court, wherein the Supreme Court gave an interesting example that a man of commerce or a man who can understand commerce would look into this transaction and say that if the purchase price is 1 crore plus 18 lakh, so the amount of tax, if it is available as a credit in the hands of the assessee, a man of commerce can certainly come to a conclusion that the cost in the hands of the assessee or the customer is only 1 crore and not 1 crore 18 lakh. So even a man of commerce can make a conclusion that tax cannot be considered as the cost of purchase of the said material. So here Supreme Court further said that we are here really concerned with the credit that has been validly taken and its benefit is available to the manufacturer without any limitation in time or otherwise. So it is a credit which was validly taken by the customer and it is a benefit which is very well available to the manufacturer. So there is no provision in the rules which provide for a reversal of the credit by the excise authorities except where it has been illegally or irregularly taken, in which event it stands cancelled or if utilized has to be paid for. The credit is therefore indefeasible. So in this case, Supreme Court has said that once a credit is taken validly and there is no mechanism to reverse a credit which was taken by virtue of satisfying the existing provisions, then you cannot challenge the credit and the credit becomes an indefeasible right. So if you recollect, vested right includes something which is an indefeasible right. So here in this case, Supreme Court has clearly held that, and it's a larger bench decision. So that is why it has a much wider importance, because it's a larger bench decision of the Supreme Court, though in the context of valuation, but they have concluded the fact that if there is no provision for reversal and the credit was rightfully taken, then it becomes an indefeasible credit. Moving further, another celebrated judgment is of that of Eicher Motors, and again it's a Supreme Court larger bench decision. So I believe most of my friends in this session will be wondering that this one aspect has gone to the Supreme Court n number of times. and that too at the larger bench level. So that is the irony, is that the government wants to give the credit to the assessee, but the department will raise various objections to deny the credit and deprive the benefit in the hands of the assessee. So again, this is a very interesting case, and it actually has a lot of relevance when we look at the GST transition credit also. So the facts of the case is such that in this Eicher Motor case, this mod VAT credit, so this case is in the context of mod VAT credit, and it is prior to this 1995. So prior to 1995, the scheme of mod VAT credit worked in a particular way, in which they had allowed you to take credit of these inputs used for manufacture of this excisable goods. So credit was allowed if you are using an input for the purpose of manufacture of excisable goods, but there was a condition that the said credit can be used against payment of excise duty only against the final product which is manufactured from such inputs. So though credit was allowed, but the utilization necessarily required the assessee to prove a nexus. So you could utilize a credit of an input against the output of the final product which is manufactured from this input only. So for example, if I have two products and I purchase a raw material for product A, the credit availed on product A or input A cannot be used for the second product, which is product B. So input for product A, you use it for payment of excise duty only for product A. So this is the facts of the case, and so this created lot of disruption, because this Eicher Motors, as an example, if I take, primarily their raw materials or their inputs were liable to duty at the rate of 15 to 25%, but the final products were liable to duty at 10 to 15%, and this created a inverted duty structure, and industry had a severe cash crunch, because at one hand credit was getting accumulated, on the other hand they are not able to use the credit for payment of duties with regard to the other goods. So to remove this anomaly, this government in 1995-1996 budget, they had amended the said provision, wherein they said that this cross utilization of credit among other products, so it became a common bucket. So that is what we are looking at even under GST. So the mod VAT credit became a common bucket, and it could be used for any product. So the credit on inputs, though not used for a particular product, it becomes a common bucket, and the said credit can be used for payment of duty for any product manufactured by the same assessee. But there came a catch. By giving this benefit, they had also put a restriction saying that this benefit is available, but the condition is that whatever is the accumulated credit on account of this inward duty structure, and the said inputs are not available with the assessee, then to that extent the credit needs to be reversed. So if I had purchased an input and I have sold all my finished products, certainly I had a case of inverted duty structure. By virtue of this amendment, they had deprived me and required me to reverse the credit which has been accumulated on account of such inverted duty structure. So this matter again went up till the Supreme Court, and the Supreme Court rightly held that if such a situation is sought to be altered, which means reversal of credit, necessarily it follows that the right which had accrued to the party is affected. So in summary, what the court has said, that it was a right which accrued to the assessee will be affected if such scheme is being introduced. Therefore, the scheme sought to be introduced cannot be made applicable to the goods which had already come into existence, in respect of which the earlier scheme was applied, under which the assessee had availed the credit facility for the purpose of payment of taxes. So it is a very good conclusion that when a credit was validly taken under the erstwhile scheme and it was available for utilization of payment of tax, this particular credit cannot be denied now by virtue of this new scheme being introduced. So it is on that basis that the earlier scheme necessarily that the taxes have to be adjusted and payment should be allowed. So here the Supreme Court had allowed the carry forward of credit, and the requirement for reversal of accumulated credit was struck down. So now this, if I look at the GST perspective, now there are two judgments. One is in the case of JCB Limited, which was given by the Honorable High Court of Bombay, where it was against the assessee. So the assessee in this case, JCB, they are also into automobile manufacture, and the context is in the case of carry forward of credit by a first stage dealer. So under the erstwhile law, a dealer who is not a manufacturer had an option to opt for a first stage dealer, wherein he could shift the credit from the manufacturer to the customer. So it allowed for the movement of credit from the manufacturer to the customer, who is also a manufacturer, who could take the credit, wherein a dealer is present between the manufacturer and the customer. So this first stage dealer enabled the movement of credit, carry forward of credit from the manufacturer to the customer. But the section 140 subsection 3 had a restriction, wherein the first stage dealer can certainly take this as a transition credit, but they had put a time limit of 1 year. So the time limit of 1 year is with regard to the invoice date. So if a first stage dealer has currently a stock of 2 years, the said law allowed you to take credit only for the last year, which is prior to July 2017. So the past 1 year was allowed. Beyond that period, credit was not available as per the transitional provisions. So in this case, JCB had filed a writ petition before the Bombay High Court, and the Bombay High Court actually gave an order in favor of the department. They said that transition credit is merely a benefit given to the assessee, and you cannot claim it to be a right. So this case was against the assessee. But if I look at the other judgment, which is in the case of Philco Trade, where the Gujarat High Court actually has given an order in favor of the assessee and held that if you look at the scheme of this first stage dealer, it was a benefit which was promised, and you had actually entitled the assessee to transfer the credit, and else it becomes a cost in the hands of the first stage dealer. So once you gave a benefit to the dealer and basis the benefit and he has satisfied all the conditions, now if you are going to deprive the assessee of the benefit, it is going to become a big cost in the hands of the assessee, and it is going to deprive the benefit or the right which was available to the assessee. So in this case, Gujarat High Court gave an order in favor of the assessee that it is a vested right, and the benefit of carry forward of credit with regard to this first stage dealer also should be allowed. So now interestingly, we have two high courts which have given divergent views, and now this matter is pending before the Supreme Court, and I am of the considered view that the order of the Gujarat High Court will be sustained, because it is more in the concept of the right which was accrued, and it became a vested right by virtue of the conditions being satisfied in the erstwhile law itself, and with reference to the Constitution Amendment Bill. Okay, so generally I think we are seeing that this Gujarat High Court is one of the courts where lot of favorable judgments are coming, but to surprise of many, there is this one judgment of this RSPL, where the Gujarat High Court actually went against the assessee on the same context of whether the credit under the erstwhile law can be denied under the GST law. But in this case, we also have to appreciate on the grounds on which the said order has been passed, and not just look merely at the conclusion. So in this case, this RSPL, the facts are, if you look at this transition credit, so the section 140 allows an assessee to take credit of inputs which are in transit as on the date of implementation of GST. So if I have purchased certain raw materials and the goods are in transit, I have not yet received the goods in my factory, the said provision allowed me to take credit even when I have physically not received the inputs. So what about capital goods? So capital goods was not specifically covered. The challenge was whether it is an error in drafting or it is an intentional case of leaving out capital goods, and the benefit of tran credit was not available to capital goods which are in transit. So this matter was challenged by RSPL before the Gujarat High Court. So the assessee has also referred to this Article 14 and Article 19. Article 14 of the Constitution deals with equality, and Article 19 deals with the right to do business. So they challenge that when you are allowing credit on inputs, it is basically denying the credit on capital goods and hence violating the principles of equality. So coming to the verdict of the High Court has stated that the statute does not violate Article 14 or Article 19 of the Constitution because it did not take away any existing right to claim the CENVAT credit of duty paid on capital goods. So the High Court observed that no such benefit which was accrued in the hands of the assessee has been taken away. Even in the earlier statute, the right to claim credit of duty paid arose only upon the receipt of such capital goods at the place of the manufacturer. So here the High Court has tried to make a differentiation that if a right accrued to the assessee, then certainly it becomes a vested right that it cannot be denied under the new law. But in this case, if I look at the facts of the case, the High Court has said that when no such right actually had accrued in the under the CENVAT law, how can an assessee now come and challenge that I had this right under the CENVAT law and the same cannot be denied? So the High Court also held that there are conditions which are prescribed for a concession, and this taxing statute contained self scheme of levying, computation and calculation of tax. So if the scheme itself provides a period on which by which credit can be availed, you cannot challenge the said scheme. So this RSPL's case was against the assessee, wherein the High Court has only looked at the aspect of the CENVAT credit provision, which did not enable the credit until and unless the said capital goods were received at the factory of the assessee. But certainly this case will be challenged before the Supreme Court, and we have to look at what verdict the Supreme Court is going to give. So another interesting case with regard to this entitlement, and my friends, I believe this is a very important case which we need to understand, because this case is which is by the Supreme Court again is giving a conclusion that when you read a provision with regard to input tax credit, you have to read it in a way to enable the credit in the hands of the assessee and not to restrict the credit. So very interesting, friends, that the court has held that when you read this input tax credit provision, please read it in a way to enable the credit and not in a way to restrict the benefit of input tax credit. So the facts here are that, again going back to this Tamil Nadu VAT Act, section 19, which we referred in the case of Jayam and company, here there was a specific restriction or a condition that if an assessee is going to make an interstate sale of goods and the said sale is not covered by Form C, so it is basically making an interstate sale without Form C, then the credit in the hands of the assessee or the dealer will be restricted. So here again it is a clear condition provided in the, under the section, that if the dealer who has purchased goods and making interstate sale of such goods without Form C, then input tax credit in the hands of the assessee or the dealer would be restricted. Now in this case of TVS Motors, the facts are that the assessee or the dealer, which is TVS Motors, has supplied certain goods to other state governments. So it is not any other assessee. They have supplied or sold these goods to state governments of other state. And if you please note, there is a specific exemption for state governments under the erstwhile law, under the VAT and CST law, that a state government is exempted from the requirement to take registration under the VAT law. So the fundamental point here is that a state government is exempted from taking registration. Then can there be a requirement that still I need to satisfy the condition of Form C, and wherein my credit is being restricted or it is blocked? So basically the question before the Supreme Court was on two aspects. One is that can there be a condition or a restriction given on input tax credit by linking it to this requirement of Form C. So basically whether it is a right or it is a benefit, whether it's a vested right or it is a benefit wherein such conditions can be sustained. And the second question was, once the government is exempted from the requirement of registration, how can you expect me to fulfill the condition of getting this Form C? So basically these are the two questions which came up before the Supreme Court. And interestingly, if you look at the verdict of the Supreme Court, the first question, again they have followed the principles or the rulings of the other courts, wherein they said that this particular input tax credit under the VAT law, it is merely a concession, it is merely a benefit, and any conditions imposed is to be strictly followed, and there is no leeway in those conditions. And they also explained that even if you look at the CST law, there is a clear distinction, because again the challenge was Article 14 of the Constitution with regard to the equality. So the court said that certainly there is a clear distinction with regard to the rate of tax when goods are sold to a registered dealer vis-a-vis a goods being sold to an unregistered dealer. So they have held the conditions to be a valid condition and the credit to be a benefit subject to condition. So that was the first aspect which was answered by the Supreme Court. Coming to the second and the most important aspect which we have to consider is that the Supreme Court has said that the provisions of section 19(5) have to be read down. So the Supreme Court said that we have to read down the condition in such a way that where the customer, in this case who is the state government, is not required to take a registration, he is specifically exempted from registration, then such conditions have to be read down. Read down means it has to be read in a way where a goods are sold to a registered dealer who's or a person who's required to be registered under the law, and consequently you receive or you do not receive Form C from such customer. In a case where the said requirement itself is not applicable, then you have to read down the said condition and the credit has to be enabled in the hands of the dealer. So hence this particular case was in favor of the assessee, wherein the condition of getting Form C from state government was read down. So please note, there is a difference between provision being read down by the courts and provision being held as ultra virus. So ultra virus means the court will conclude that the said provision is invalid. They invalid or they strike down the entire provision which is a subject matter of the litigation. Whereas a term read down, they do not invalidate the said section, but they read it in a way which gives a better meaning and the said conditions continues. So here please make note of this judgment of TVS Motor. Whenever you have a challenge of credit being denied, please read this provision as to how the credit should be read or a condition should be read in a way to enable the credit. So you have to read down the condition. The said judgment of TVS Motor will also have a relevance when we come to the aspect of the condition of payment of tax by the dealer. So the second aspect, so we have looked at the first aspect so far, which is on the entitlement of credit. So to sum up, I would conclude, in my view, credit, though a benefit, once I fulfill the conditions and restrictions, it becomes a accrued right, and more so it becomes a vested right if the department tries to deny the credit at a future date. Okay, so now when I'm looking at the term intention to use versus actual use, so even in the CENVAT credit, if you recollect, this definition of input services had a wide coverage by the term usage, the services used in relation to business. So this term in relation to business have been a subject matter of various judgments, wherein this term in relation to business itself was considered much wider. So here we are looking at the term intention to use versus actual use. So here we are not going to restrict the credit only on account of the actual use, but the intention of use at the time of availment is very important. So here in the case of Dalmia Dadri Cement, Supreme Court had a case where the Dalmia supplied cement for an electricity company for the purpose of creating the facility for generation and distribution of electrical energy. So there was a specific benefit available if cement was supplied for the purpose of generation and distribution of electrical energy. So here the department disputed that the assessee here, Dalmia, needs to prove that the customer has actually used it for the said purpose of the exemption, which is generation or distribution of electricity. So they had a case where the assessee is required to prove the actual use. So here the Supreme Court has read the term for use must mean intended for use. It further observed that if intention of the legislature was to limit the exemption only to such goods sold as were actually used by the undertaking in generation and distribution of electricity, then the wordings in the said provision would have been different. They would have used the words goods actually used or goods used. So here they have given a wider meaning to the term intention to use. So an assessee, if it is able to justify that the credit or the supply has been made with an intention for a particular purpose, then it is sufficient. You need not go ahead and prove the actual usage. Another judgment is in the case of this Prakash Metal Craft. Again, here it is supplying of tractor trailers, wherein the assessee had supplied this tractor trailers to dealers, and ultimately the dealers would be supplying it to agriculturists who will use it for agricultural purpose. So there was an exemption which was available for sale of tractor trailers which are used for agricultural purpose. So here again department tried to deny the benefit in the hands of the manufacturer, saying that you are not selling the tractor trailers directly to the agriculturist, rather you are selling it only to a dealer. So hence the condition of use will fail in such cases. So again this matter went to the High Court, and the Madhya Pradesh High Court had held that when you look at the requirement of the exemption entry, you have to consider the intention, which is intention for supply of such tractor trailers is for the final use by the agriculturist, and they held that it was immaterial whether these were sold directly to the agriculturist or to the agriculturist through a dealer or a distributor. It was not necessary for the assessee to establish that the trailers sold were actually used for agricultural purpose. So even here courts have held that the intention of use is sufficient and the supplier need not prove the actual usage. So when I look at the GST section 16, intention of use is also covered as part of the entitlement. So when I am purchasing any input services or capital goods, if I can demonstrate that there was an intention to use it for business purpose, then credit is available in my hands, subject to the conditions in section 17. So intention of use, my friends, has a much wider importance. So if the assessee is able to prove the intention at the time of purchase, certainly credit can be availed. The third element which we will be discussing now is on the aspect of in the course of furtherance of business. So as I explained earlier, the CENVAT credit had the term in relation to business. So in relation means it has to be something connected to the business, but the term in the course of business is much wider, and course means anything and everything which I do as part of my business is in the course of business. Furtherance of business means anything which I do which will further my business or my which will have an effect on my business to grow further. So if I compare this with the erstwhile CENVAT law, we can probably take a conclusion or take a cue that in relation has to have some connection with business, but the term in the course is much wider and it need not be directly connected with the business, but anything and everything I do in the course of my business should be available. So now when we are looking at some of the jurisprudence under the earlier law, certainly this can be applied, and this particular case law is with regard to the term in relation to business. So the term in the course of business is much larger, and the scope of the term in the course is much wider than the term in relation to. So the celebrated judgment of Coca-Cola India, where this Mumbai High Court had a very interesting case, that if you look at this Coca-Cola, they have two entities. The first entity manufactures the concentrate and it sells the concentrate to the second entity, because this concentrate is a highly protected and a very highly confidential formula which cannot be shared with any assessee. Arjun, am I audible?
Yes, sir. You're audible.
Yeah.
Sir, just one thing.
Yeah.
We have 30 more minutes, sir, for completing
Yeah.
the session.
Another 15 minutes, I think we will be able to cover. 15,
Okay, sir.
20
Okay.
minutes. Take the question.
Okay. Thank you.
So here the question was, this company which manufactures the concentrates and sells it to the other entity for manufacture of the beverage, they had incurred the expenditure of advertisement for the beverage as a whole. So here the department raised an objection that the credit which has been taken on the advertisement is for the sale of beverage and not for the sale of concentrate. Hence, credit cannot be availed. So in this case, the High Court has actually made a very good interpretation of the said provision, and they held that the term in relation to business should cover anything which is going to have an impact on my business. So when I'm doing an advertisement of a beverage, and this will enable further sale of beverage, indirectly it is going to increase the sale of concentrates also. So in this case, the Bombay High Court has allowed the credit in the hands of the assessee, even though the advertisement is of a product which is not manufactured by the assessee, but it is indirectly related to its business. So certainly we can use this judgment. Ultratech judgment, I think most of you are familiar, where the court again has read the word in relation to business to construe as anything and everything which is directly or indirectly used in the business of manufacture. So again, this is a judgment which you can rely upon. So interestingly, we can look at these three judgments under the income tax regime sorry, wherein they have dealt with three interesting cases. In the case of this Malgaon dock, the Supreme Court has held that the word business has often been said to be one of the wide import in the fiscal statutes, and it should be construed in a broader sense rather than a restricted sense, because generally under income tax we are dealing with allowability of expenditure in relation to business. So here they have held that the term business should be considered as a wider import, and you should not restrict it by denying the benefit in the hands of the assessee. Second is again Dhanraj Giri. Supreme Court has held that it is not open for the department to decide what type of expenditure the assessee should incur. Many a times you could come across a case where department would challenge the nature of expenses, saying that it is not at all related to your business, hence I will deny the credit. So here kindly refer to this judgment of Dhanraj Giri, wherein Supreme Court said that it is not open for the department to decide what expenditure a company should do. It is up to the company's own commercial or a business decision what expenditure they want to incur, and you cannot raise an objection. For example, if I want to conduct a conference for all my dealers and it is done at a 7-star hotel, so department cannot say what type of expenditure I need to do, whether I have to do it in-house or I can do it outside the said premises. So it is only for the assessee to decide. The same principle as supported in the case of Walchand, that the amount of expenditure again cannot be questioned. Similar example of me doing a conference for my dealers at a 7-star hotel. If I incur 1 crore expenditure, department cannot challenge that 1 crore is unduly high. It is up to me to decide, and the quantum of expenditure cannot be challenged. So this judgment also can be adopted when we are looking at the concept of the nature of credit and department raising an objection on the type of expenditure or the amount of expenditure incurred. Okay, now we are looking at the fourth aspect, which is again the condition and restrictions imposed by the law. Whether it is a condition which can be imposed is the question. So in the case of this onquest, this Delhi VAT had a requirement wherein the buying dealer has to prove, or there is a condition that if the selling dealer does not pay tax to the government, the credit would be deprived in the hands of the buyer. So straight away I can correlate this with the condition of payment of tax by the supplier, and there are a lot of cases where notices are issued where the recipient is deprived of the credit. So in this case, there were a bunch of writ petition filed before the Delhi High Court, wherein Onquest was one of the petitioners along with Arise India. So here the Delhi High Court has come to a conclusion that the condition of payment of tax again has to be read down. So here, interestingly, the High Court has read down the condition of payment of tax by the supplier. So they said that in case of a bona fide transaction wherein the recipient has made a bona fide purchase and has paid the applicable taxes to the supplier, and the recipient has no means or no mechanism to verify whether the supplier has paid tax to the government or not, in such cases this condition has to be read down to the extent that if the buyer and seller have colluded and it is a case of both of them having an intention to create a bogus transaction to deprive the tax and to create a bogus credit in the hands of the recipient. So this High Court has clearly distinguished that this condition of payment cannot be applied to all cases, and it has to be looked only in the case where the buyer and the seller have colluded and clearly there is an intention to defraud the revenue. Else this particular condition will create lot of hardship on the assessee. So this is a very important judgment, my friends. And as I have told, Arise India was one of the petitioners in this case before the High Court. So there the revenue filed a special leave petition before the Supreme Court, and Supreme Court has dismissed the petition filed by the revenue. So hence now this becomes the verdict even of the Supreme Court that this condition of payment of tax by the supplier has to be read down, and it has to be understood only in the case where there is a collusion between the supplier and the recipient, and not in the case where there is a genuine transaction. So this is a very important judgment, my friends. So this can be noted. Arise India in the case of the Supreme Court, which has dismissed the special leave petition, and the bunch of writ petition, High Court of Delhi. I have given the citation. Please, you may make note of the same. So KK Industries again going by the simple principle that if there is a condition which is requiring a due care to be taken, then assessee cannot be enforced to ensure that the said compliance has been done. So maybe this judgment of KK Industries also can be referred, wherein the condition of due care was looked to the extent it is possible for the assessee to fulfill. So anything which is not possible, you cannot enforce the assessee to follow and comply. So in this case, this one important legal maxim, which is lex non cogit ad impossibilia. Impossibilia means if there is something which is practically impossible, you cannot expect the assessee to do, and hence the said provision has to be read down to the extent it is possible for the assessee to comply. So in this case of this Bombay Chemicals, which is a Bombay High Court judgment, which has followed the Supreme Court verdict in the case of Hiko Enterprises, is that when a license, import license was purchased by an assessee from another exporter, so an exporter has obtained a license basis their export obligations. So there the license had certain conditions to be fulfilled by the exporter. So the exporter has procured the license, and this Bombay Chemicals has purchased the license from the said exporter. So later it was found by the department that one of the conditions for obtaining the license was not satisfied by the exporter. So in this case, the department actually denied the benefit of the license in the hands of the buyer of the license. So there this Bombay High Court has held that when the license was issued by the DGFT, it is the DGFT who does the validation. You cannot expect the assessee, that is the buyer, to go beyond the validation of DGFT, and there is no mechanism available for the buyer to go and check whether the said license has been validly obtained by the seller of the license. So again here, if it's an impossible task, you cannot enforce a condition to be satisfied by the assessee. So the same principle you can apply for the condition of payment of tax, because we have this 2A, but 2A is merely a reflection of GSTR 1. Just because an entry is reported in GSTR 2A, it does not mean that tax has been paid by the supplier. So probably if I have to read down the said provision with reference to all these cases, I would say that if I verify GSTR 2A and if the invoice is reported, I can come to a conclusion or an assumption that tax would have been paid. I cannot go behind my supplier to ensure whether tax has been paid. So reflection in 2A can be construed as a complaint for tax payment because I do not have any other mechanism to prove payment of tax by the supplier. So HECO enterprise is again on the same principle of impossibilia. Okay, here again this ITC limited is an interesting case wherein the levy of excise duty on cigarettes was based on the selling price or the MRP at which the said cigarettes are being sold. So there were 3 slabs at which this excise duty was applicable, and the duty had to be paid based on the MRP affixed. And if I recollect, the slabs were like up to 60 rupees there was a slab, 60 and say 70 there was a slab, and beyond 70 there was another slab. So in this case, this ITC Limited has sold cigarettes with an MRP of 60 to all its dealers. But as you all know, the cigarettes being an product where the retailers will charge their own price. So department did various surveys and found that at the ground level reality, the cigarettes are not being sold at MRP, but are sold at a price which is beyond the MRP. So it was being sold at 70 and 80 rupees also. So then the department went back to ITC challenging that you have given an MRP of 60 rupees, you are paying tax at a lower slab of 60 rupees, but in fact the retailers are selling it at a higher rate. So in this case, the CESTAT had passed an order against the company saying that company has to ensure that the price at which the MRP is fixed should be a reasonable price, and they had passed an order against the SSC. But Supreme Court held that nothing doing. The order of the CESTAT or the tribunal is totally illogical because you cannot expect the company to go across the country and verify at what price the retailers are going to sell the cigarettes. So it is something which is not practically possible for the assessee as well as for the department. Department also cannot go across all states and all cities in India and determine cigarette by cigarette at what rate it is being sold. So when a particular aspect is not possible to be validated, there cannot be a additional demand in the hands of the manufacturer of cigarette. So this is with regard to the condition of payment. So please note that we can certainly look at the situation where we can read down the provision and make it implementable to the extent it is possible to satisfy the said condition. The another aspect which we are going to touch upon now is the question of reversal of credit on account of non-payment of vendors within 180 days. So certainly many times there is a lot of discussion whether failure to pay and default to pay are two different terms. For example, if my own dealer is giving me a credit period of 120 or 200 days, can there be a requirement of reversal wherein the dealer himself has given a credit period of 200 days? Some contracts credit period can even be for 1 year. For example, the credit period in terms of a retention amount. So retention amount is agreed to be paid after a period of 1 or 2 years. So can there be a requirement for reversal of credit? So as of now, there are no specific jurisprudence which are available. But interestingly, if I look at the concept by which this said condition has been introduced, the background by which this condition was introduced. So the CENVAT credit rules had a requirement of reversal only for input services where the payment was not made within 90 days. So they had actually copy pasted the same requirement under the CENVAT rules under the model GST law. So when this council meet happened, the 5th council meet happened before implementation of GST. So the West Bengal finance minister raised a point as to why there is a distinction of this credit being restricted only for services and why not for goods. And also he wanted to understand, when the supplier himself is going to give the benefit of additional time, will there be still a requirement of reversal? So there the commissioner of GST explained that it was only an anti-evasion measure and the credit reversed after 3 months can be taken again by the recipient. So please note that it is a case of anti-evasion measure, that the intention of the council was to have an anti-evasion measure and not as a case to enable payment of taxes by the supplier. So it is only a case where in case of services where bogus transaction can happen, they had put this condition of payment. So this fifth council meeting, the background set was that it's an anti-evasion measure, and basis the question raised by this West Bengal minister, they had decided to include even goods. Originally it was only services, later they had included the goods also. And if you actually note, this 28th council meeting had a press release wherein this requirement for payment of interest was proposed to be waived off. So if reversal is done beyond 180 days, the requirement of reversal was also proposed to be removed. So many of us were very happy that though there is a requirement for reversal, there is not going to be a requirement for payment of interest. But no such notification came after this 28th meeting. So when I did further research, I found that in the 29th meeting again this matter was raised, that you had proposed to waive off this interest, but it may not be appropriate. And the point raised was by the chairperson of the council was that he stated that the original formulation of the proviso was more beneficial to MSME, and then deletion of the phrase along with interest would reduce the incentive for timely payment to supplier, especially to MSME. So here again they are clarifying the fact that it is only trying to safeguard the interest of MSME, wherein this interest will act as a detriment for the person not to make payment within the time of 180 days. So it is not linked to the tax liability to be discharged by the supplier. It is merely a intention where they want to enable the funds in the hands of MSME. So when I look at these two council meetings, certainly again I can read down the set condition of 180 days, saying that the condition is provided where I have a requirement to make payment to the supplier within 180 days, but I have not paid within 180 days. So only then this condition will attract. If the agreement is in such a way that the credit period itself is beyond 180 days, then possibly with reference to this council meeting minutes, which is the 5th council meeting and the 29th council meeting, I can draw a conclusion that I can read down the said provision to enable the credit and not to reverse the credit at a future date. So hope I was clear in this part. If people have any questions on this regard, we can take it up in the question answer session. So the final aspect which we are going to look at is this 36.4. 36.4 again is creating this confusion where you have to match the input credit for the purpose of availment. So it is giving a condition to match the credit. Now if I look at the section 16.1, it generally says that subject to such conditions and restrictions. So if I look at section 30, this rule 36.4, nowhere they have specifically said that it is in relation to 16.1, but though it is part of that rule 36, which is the documents basis which you can take the credit. Now the challenge comes is that when there is a specific provision which was introduced, which is section 43A, time being which is deferred on account of this new return, which provides for matching of credit. Can there be a argument that the said rule is linked to 16 and not 43A? So then what is the relevance of the new provision being introduced, which is 43A? So certainly this will be tested, and I believe there are certain petitions already pending before high courts challenging the validity of the said rule and whether it is ultra vires the CGST Act. So if this said rule is held to be ultra vires the Act, basically this judgment of this global energy where the Supreme Court has held that the rule making powers for basically the rule making power is for carrying out the purpose of the Act. So it is a general delegation. The rule by itself cannot create a new restriction or a condition which is not provided in the Act by itself. So rule is a subset or it is a delegation by the Act which is enabling creation of certain procedures and forms which the assessee have to follow to satisfy the conditions which are provided in the Act. So in this case, if this rule 36.4 is held to be ultra vires and it is not linked to this section 16, then probably this entire requirement of matching of credit under 36.4 will fail. Okay, the last aspect of my session for the day is on the time limit to take credit. So generally many people and clients have asked us whether the time limit prescribed in the act, which is the September of the following financial year, or the due date of filing annual return, whether it is a valid condition. Because if you say that the credit becomes a accrued right, can a time limit take away the benefit in the hands of the assessee? So again, in this case, this ALD Automotive Private Limited, which was a VAT case, again a Tamil Nadu VAT case, where the Supreme Court has analyzed the requirement of time limit, or the condition of time limit provided under the TN VAT Act, which said that the credit has to be availed within the same financial year or 90 days from the end of the financial year. So here the assessee took the credit beyond the state stipulated time limit, and the department had denied the credit in the hands of the assessee, saying that it is beyond the time limit which allows availment of credit. So here Supreme Court has actually ruled in favor of the revenue and said that though it is a benefit or a right which is an accrued right, if there is a condition of time limit, the said time limit has to be strictly followed, and it is not violative of Article 19, which is right to do business. The legislature has the power to impose restriction of time. So basically they are saying there is a time limit by which credit can be availed. It is not a situation that you cannot avail the credit at all. Legislature has given you a time which could be a reasonable time or otherwise, but once a time limit is prescribed, you need to take the credit within the set time. So certainly you will not succeed if you are going to challenge the condition of time limit on the ground that it is violating the principles of Article 19, which is right to do business, and saying that it is a vested right and hence this condition cannot be imposed. So as I said, we should look at the credit as a benefit which converts into an accrued right, but the conditions and restrictions have to be followed. But when I'm following the condition and restrictions, I have to read the condition and restrictions in such a way to, point number 1, enable the credit. Point number 2, when any condition or restriction is going to create an impossible situation or a situation which cannot be complied, then I have to read down the provision in a manner in which the said condition can be fulfilled and could make more logical conclusion. So the last slide is on this Formica India division. So it is actually a slightly different context where the assessee actually took the benefit of exemption of the intermediary product and paid taxes on the final product, and they are not fulfilled certain conditions of Rule 56A. Later it was held that the intermediary product also was taxable and the conditions of Rule 56A was required to be satisfied. So there the courts held that if the assessee took a position that the product was exempted, subsequently it is held that it is taxable, an opportunity should be given to the assessee to fulfill the conditions, because no way he could have fulfilled the conditions if the position was taken that the product was exempted. So here the Supreme Court gave an opportunity to the assessee to fulfill the condition even beyond the prescribed date. But this case may not straight apply to our case, because it is no such condition which can be fulfilled post facto, but it is merely a condition which is linked to a time. So we have to see whether this Formica case can be adopted even under GST, and if someone has a challenge of availment of credit, certainly this ALD Automotive and this Formica India judgments would be considered, and we have to see how the courts will conclude with regard to this time limit on GST. But as of now, we can conclude that the time limit will apply and the judgment of ALD prima facie will hold good, and it is a condition which is provided and it cannot be bypassed. So with this, I thank you all for patiently listening to my session, and certainly it is almost 1. I know people will also be hungry for lunch. So I now hand over the session to Arjun for the next part of the session. Yes, Arjun.
Sir, thank you, Vikram sir, for your elaborate deliberation. Now I would invite ROOPA madam for providing her comments. Madam. ROOPA madam. Hello. Roopa ma'am, am I audible to you?
Yes, you are audible.
Yes, madam. Can you?
Thank you, Vikram.
Yes, madam.
Thank you, Vikram. It has been a really good session, and Vikram has covered substantial aspects pertaining to the jurisprudence, the development of the case laws, right from under central excise to the very, very relevant decisions which are coming day in and day out in the context of GST, transition credit. So herein, two aspects I would just like to touch upon. First and foremost aspect, which is there is Vikram has emphasized to us right in the beginning of his deliberations that there is an entitlement to take credit of the input tax of goods or services which are used or intended to be used in the course or furtherance of the business. So as he said, business, now this usage in the course or the furtherance of the business, it's a very essential precondition which is there for the purpose of availing the input tax credit. So here, from where do we take a cue? Do we say that business means anything and everything which is an action or an activity which is done by an SSC or a taxable person or a registered person, or is there some way by which we may get some idea on this aspect? Probably we can look at the definition of business which is readily available in the GST law itself, wherein if we are to see, it is defined in an inclusive manner to cover any trade, commerce, manufacture, profession, vocation, similar activities, transactions which are incidental or ancillary to this trade, commerce, manufacture, and also one-off transactions could get covered. So any activity which is of the nature of trade, commerce, buying, selling, manufacturing, or supplying, even whether or not there is a volume, frequency, continuity, or a regularity in such transactions. Keeping this on the one side, the definition, probably it would help us to get some kind of an idea as an SSC as to which may be the credits which are eligible. Of course, the goods or the services which are directly entering into the supply of the manufactured product or the supply of the taxable service, there is no doubt at all. Because without that, you cannot give the supply of the product or the supply of the service. But what about the others which may not be directly getting used up in the supply of the goods or the supply of the services, but which is incidental, which is contributing? It could be something as simple as, if I look in the services side, it may be say housekeeping services. But without the housekeeping services and the cleaning of the premises which is there, be it a factory or a service provider's office, obviously it is for the purpose of the business itself. It is for the carrying on or the running of the day-to-day operations itself. So these aspects also we may like to keep it in our minds when we are looking at any particular item to see whether it is a credit which we may be eligible, for the reason that it is satisfying the requirement of being used for the business purposes, though not directly used for the manufactured goods, though not directly becoming a part of the cost of the supply of the services. One more aspect I would quickly like to touch upon before we will be taking up the questions of the participants. This is the aspect relating to what Vikram once again said, and I would just like to quickly touch upon is the point about receiving the goods or the services, or both being something which is also required for the purpose of availment of the credit. So here if you see, there is some kind of a mismatch. If you look on the one side, we have the definition of the supply which is given in section 7, wherein it is talking again in an inclusive manner. The expression supply includes all forms of supply of goods or service or both, such as sale, transfer, barter, exchange, license, rental, lease, disposal. I will emphasize here, made or agreed to be made for a consideration, which means even the agreeing to make a certain supply for a consideration at a future date also they seem to be indicating is very clearly a supply. It need not be the actual supply needs to be taking place. Even a promise or an undertaking should be sufficient. So coming on the other side, if you look here, one of the important conditions for availment of the credit is that he has received the goods or services of both. No registered person is entitled to the credit of the ITC on the supply of goods or service unless he has received the goods or service of both. So can this be imputed to cover a situation? For example, let's say there is an insurance service. Now the invoice is being received in this month. The services obviously they will cover for the period of the next 12 months. Now, can it be said there is being a receipt, or can a Q be taken from the definition of the scope of the supply and say that equally here also it is deemed to have been received or it has been agreed to be received? It may not be so. To extend something from the definition of the expression of supply, the scope of supply, and applying it here may be a little far-fetched. But then again, we may need to see, depending on the nature of the service, whether the credit may be taken. Because in some cases, such as insurance being one of the examples, it's not the receipt of the actual claim, but the undertaking or the promise that they are going to make good. In case there is any loss, in case there is any damage, in which case when they make good the claim, that promise which they give right at the beginning, that itself may be said to be tantamount to receipt of the services. So based on that, the possibility to take the credit right in the beginning when the invoice is dated, say in May, but the services or the coverage of that promise is for the next 12 months, may still enable us to take the credit now. Yeah, Arjun, can we take the questions? Vikram?
Yes, thank you, Rupa, for that insights. Then just one point.
Yes.
Certainly, this topic of section 16 is much bigger, and I have tried to cover all the relevant points. So I think this PPT also will be shared. So I request you also to glance through the said judgments so get a better clarity in terms of how these judgments can be applied. Yes, Arjun.
Yeah, Arjun,
Okay.
how we will go about this is you will be raising the query. Vikram ji will be answering, and if there is any additional aspects, I will just add on to that. Yeah.
Yes, madam. Yeah.
Yeah, please proceed.
Okay. Vikram sir, the first query of today's session. Sir, under section 16, one of the condition, basic condition to avail the input tax credit is registration. So it is starting that every registered person shall entitle the credit. So while reading that, how to interpret at the time of receipt of the service, I should be registered, or once I get registered, I can take the credit of past transactions.
Okay. So as I've said earlier, the credit prima facie is a benefit which accrues to you as a right once you fulfill all the specific conditions. Okay.
Yes, sir.
So, and also if you look at the parallel requirement of this rule 36(4), which is now introduced, which requires a matching of credit for the purpose of availment. So I'm just connecting the dots that there are various other requirements which are linked to the said aspect. So now if I look at a case where the section 16 starts with every registered person shall, so it is giving a benefit or a right to a registered person, but it does not clearly come out with the point that at the time of purchase or at the time of receipt of goods, the said person should be registered. But practically you will have a challenge because the supplier's invoice will not have your GST number at the time of the supply being made. So again, you will be looking at the restrictions in rule 36, wherein the invoice has to be a proper invoice with your GST number. So though one can argue that it does not provide at what time you have to be registered, but practically if I have to connect all the other requirements, it could be a far-fetched perspective to be taken. Rupa?
Yeah. So just to add on to what Vikram said, obviously this is something which is a carried forward query, I would say, which used to be there in excise and service tax. Because under excise and service tax, even though a person was not registered or was registered later, there was always a facility that the credit of the pre-registration period also used to be taken. We have a number of judgments also, like M-Portal Wireless of Karnataka High Court and several other decisions which have been there, which basically stem from the philosophy I think Vikram has covered in one of his slides of Formica. Correct, Vikram?
Yes.
Yeah, so wherein he has also touched upon that very correctly to say that once I'm offering on the output side as far as the taxes going to the revenue, the input side credit should not be denied. But unfortunately, as he has explained just now, though there has been past case laws, past references which are in favor of the SSC taking even the pre-registration credit, but today there is a specific requirement which is enshrined in the law which says that the person has to be a registered person. And one more thing is there's a requirement of having the GST number. So these two requirements being there, though we may say that it is a procedural requirement which is there, and even in spite of that, if we have not had that requirement getting satisfied, still it should not be denied. But I would say the prudent SSC who does not want any kind of a dispute is suggested to take the credit only based on the invoices which are containing his GST registration number as obtained by him at the time of registration and proceed. Next.
Arjun, I just want to add one point here. Probably, if an assessee is willing to take the litigation or it is ready to fight out the credit being a significant value, you can certainly take the credit, but this practical challenges will have to be read down by the courts to enable the credit.
Oh, that's well taken. Yeah, please. Next.
Sir, moving on to the next query. This is in relation to like kind of this annual return. Sir, at the time of filing annual return, I found out I have missed the RCM liability of previous financial year, like 17-18. I have paid such liability in the financial year 19-20. Can I claim the credit in the financial year 19-20 or 16-4 might apply?
Okay. So this is annual return of 17-18 or 18-19? Because the answer. Okay. So if you look at the restriction under section 16.4 and closely if you observe, the time limit is actually linked to the date of the invoice or the date of the debit nota. So it is very clear that it is linked to the date of invoice, and in case of an RCM credit, I will be raising a self invoice in case of an unregistered dealer and also in case of a registered dealer. In case of a registered dealer, I may have some challenges because my customer is also, my supplier is also going to raise an invoice on me. But in case of an unregistered customer, where I'm paying an RCM, unregistered supplier when I'm paying an RCM, so there probably you can take a ground that the invoice date, which is the self invoice date, becomes the date basis which you take the credit. But however, please note that there is a specific proviso to the said section 16.4, which is linking the time of supply for the services provided in financial year 17-18. So for the financial year 17-18, they are linking it to the time of supply, which is reported and with regard to the GSTR1 filed by the suppliers. So if I have to summarize this entire discussion, in case of an unregistered supplier, this time limit is purely based on your own self-invoice date. So you need not worry, you can take the credit. If it is a credit with regard to supplies received from a registered supplier, but the transaction is covered under RCM, for 17-18, you may not be eligible to take the credit now. For 18-19 onwards, you can still take the credit. Roopa?
Okay.
This is the way in which we can take it further. And in my understanding, even if there is a risk of a dispute, this is going to be a defendable proposition. What about the interest, Vikram? Probably we may like to comment upon the interest also. Should they pay the interest or not for the delay?
So this RCM liability anyways, the due date had triggered in the past, in the 17-18 financial year. So there is no escape route from the interest liability on the delayed payment of RCM liability. But only with regard to the ITC, when we are looking at eligibility beyond this particular time limit, still you will satisfy provided your own self-invoice date is raised in the current financial year.
Next, Arjun.
Okay. Sir, moving on to the next query. This is in relation to Rule 36.4, sir. So here, for the financial year 17-18 and 18-19, my vendor has not uploaded my invoice in GSTR1. However, he has uploaded such invoice in current financial year in 2021. So will it impact my eligibility of input tax credit relating to previous financial years?
Okay. So now you can take two grounds to say that this particular matching does not apply to the previous periods. So the first ground is that
Yes, sir.
when I have taken the credit in 17, 18, 18, 19, with reference to all these judgments which I have told, even Eicher Motors and the other cases, at the time at which I have taken the credit, no such restriction was in place. Hence, you cannot apply this restriction introduced in the current financial year to a past period. So that is the first ground you can say that this matching is not applicable for 17, 18 and 18, 19 and part of 19, 20. The second ground which you can take is that the reference which I made in my slide is that there is already a provision of 43A, section 43A, which is time being deferred. So whether this rule 36(4) can be linked to section 16 and not to this 43A. So by that virtue, I can say that this rule is ultra vires section 16 because it is only with reference to 43A. Roopa?
Okay.
Yeah, I think I broadly tend to agree with Vikram on this. Please.
Okay. Moving on to next story, sir. This is also relating to the same. Sir, this is credit relating to 1718. I have made the payment to the supplier and he has uploaded the invoice also in STR1. It is reflecting in my 2A. Presently, the department has issued ASMT 13 to me stating that the supplier has not filed 3B. He has filed only GSTR1. So based on section 62 subclass C, the payment condition, now the department is demanding me to reverse the entire credit. How to proceed in this regard?
Okay. So here, as I have explained, this case of this Arise India, which was again upheld by the Supreme Court, where they dismissed the special leave petition, saying that the condition of payment by dealer has to be read down in a particular way where the supplier and the recipient have colluded and there was a malified intention to defraud the revenue. So in case of a genuine transaction where I have received a valid invoice, I have actually received the goods and services and I have paid the tax to the supplier and I have also taken credit in my GSTR 3B. So this condition of payment of tax, which is an impossible condition for me to satisfy, and I only have a view of GSTR 2A. So if I have verified 2A as a comfort or as a if I can read down the condition of payment to also looking it at compliance with 2A, I can conclude that tax has been paid by the supplier and any such default by the supplier has to be recovered from the supplier. There are certain judgments wherein the courts have held that if there is a default by the supplier, even this I think OnQuest has referred this point, that if the default is from the supplier, the department should first proceed against the supplier only to recover. And if it is proved that the recipient colluded with the supplier, then only you can go behind the recipient to recover the said credit. So I feel you can read down the provision basis these arguments. Roopa?
Yeah. He made a very interesting point here. This is a very valid thing because there are so many decisions. I think again I was just running through Vikram's PPT in that he has covered all those Supreme Court decisions also which are there. The one line thing is that you cannot penalize the recipient for the faults of the supplier. Second, even coming to 2A, what is the 2A? It is only a facilitation measure. Assume that a credit is not even getting reflected into the 2A, but anyway, you have discharged as a recipient your tax plus the value of the consideration to your supplier. Still, the credit should be very much available and defendable, though the department could question and though the department could ask for reversal of payment of this. There is also a circular on this, 2A being only a facilitation measure. So I think from there we can take it further. Yeah.
Okay. But, okay. Moving on to next query, sir. Vikram, sir. Sir, in relation to this 180 days reversal, in Rule 37, it is providing that once I make the payment, I can reclaim the credit. So, based on that, can I claim the refund of interest which I have paid?
Okay. See, now there is this mechanism which allows you to take the credit, but there is no mechanism for you to claim back the interest because if you I also refer to the 29 GST Council meeting minutes, sorry, minutes, where they have specifically stated that the aspect of interest should not be removed and should be continued, because it will give an incentive for the recipient to pay the amount to the suppliers on time. So in this case, this refund of interest is not possible. But please go through the minutes of the council meeting also, especially the 5th council meeting, 28th and the 29th, to get a better understanding and perspective of why this condition is being imposed. Rupa?
Agreed.
Okay, sir. Sir, moving on to next query. Sir, I am running a minerals crushing unit. So for the purpose of that, I have purchased a fridge, a heavy fridge for my lab, which worth 8 crores. Am I eligible to claim the ITC of such fridge?
In my view, clearly eligible. I don't find any restriction, provided your output is liable to tax.
Correct.
Okay. Moving on to next query, sir. Sir, in relation to the 16.4 time limit, section 16.2 start with the overriding effect. It's notwithstanding anything contained in this section. So, since it is overriding the entire section, can't we take a stand that section 16.2 overrides even section 16.4, and one side eligible to claim the credit and subsection 2 time limit will not apply?
Okay. So whenever you read a term notwithstanding, which is a non-obstant clause, so it is giving an indication that if there are two provisions and there is a conflict between these two provisions, so the provision which has the non-withstanding clause will override the other. So it is not a case that this provision will override all provisions irrespective of whether there is a conflict or not. So when there are two independent provisions having independent conditions and not having a conflict with each other, this particular proposition cannot be taken. So they are independent conditions only if there is a case where there is a conflict between two. For example, section 16 gives me an entitlement of credit, but section 17 is a non-obstant clause to section 16. So even though I'm eligible, if there is a restriction under section 17, that will override. But in this example, the condition under 16.2 and 16.4 are independent, and hence this particular non-obstant cannot be taken even for time limit. Rupa?
See, if you look at it, yes, broadly it is correct, because these are addressing to different spheres. But having said that, if you are having a case on hand wherein, let us say, for example, you have already gone ahead and you have done now a filing of the returns, for example, which has happened with a delay, then I would say nothing wrong in trying for this particular ground. Nothing wrong in trying for this ground, but it is going to be a subject matter of lot of dispute and debate, because the correct view would finally, if you ask for your reading of this law, will be whatever Vikram has just explained.
Okay.
Yes, sir. Yes, sir.
Sir, moving on to next query. Madam, shall I move for next query, or you want to add more?
Please proceed.
Sir, I have not filed the TRAN one till date due to technical issues which I have faced. Considering the recent judgments of Delhi High Court and Gujarat High Court, what would be your suggestion?
Okay. So I think he's referring to this brand equity judgment and the other judgments. So now this amendment of the section 140, wherein they have also prescribed the time limit which has been notified now. So if I broadly, if I recollect, this brand equity judgment is not specifically talking about the amendment which has been introduced. So the order has been passed with reference to the section as it existed prior to the amendment of this time limit being added. So that is one element. The second part is they have also gone into the understanding that when the GST department or the government itself was not ready with a proper portal, how can you restrict the credit in the hands of the assessee, wherein at your convenience you are continuously extending the dates, but if the assessee is not able to file the return, you are not giving the benefit. That is where they looked at the time limit under the Limitation Act. But the challenge now is, since the act is now amended, so anybody who's now going to fight for this case may not succeed. It is only those people who have already fought the case and got a favorable order and credit has already been taken, so their rights will now not be disturbed. But henceforth anybody is planning to challenge it on account of this brand equity judgment, they may not succeed, is my view. Roopa?
Correct.
Okay.
Yes. Yes, sir.
Moving on to next query. Sir, I have availed the credit of IGST wrongly as CGST SGST in my 3B in the financial year 18-19. Now, considering the time limit also completed for adjustment, so what would be the legal process which I need to take care? Now, what I need to proceed with?
Okay. So here again I will share my view. Maybe Roopa can add, modify or correct it. So in my view, if you look at the provisions of input tax credit, it is specifically or independently given under the CGST Act, also provided under the SGST Act. And if you look at the IGST Act, it also has a specific provision which borrows the principles or the provisions of input tax credit from the CGST Act. So technically, this input credit provision also applies separately for the IGST credit. So that being the case, the time limit will apply independently for all the three. Those C plus S go hand in hand. So I would say the time limit applies for all the three independently. So in your case, if you have taken a wrong credit, say C plus S instead of IGST, so the wrong credit taken by you certainly will be challenged and you may have to reverse that with interest, provided you do not have sufficient credit balance. But the question of taking the credit of IGST beyond the time limit may not be possible unless, as Roopa said, certain aspects needs to be challenged on certain different grounds, and this particular principle should evolve by the courts. And at the first level, certainly it is, in my view, it is not possible to take the IGST credit beyond the time limit. Roopa?
Yes. See, what I would suggest to any taxpayer is to see what is the materiality of the amount which is involved. Keeping that in sight, and also what is the risk appetite which is there in the management. If on both these counts the amount involved is negligible and the risk appetite of the management or of the company or the SSC also is not much, and you do not want to be foisted with any notices which will affect the valuation of the company, probably the company has certain future plans for itself, you need to take a view in such a way that yes, it is definitely possible, it is disputable, you have to go through the judicial channels, and finally the relief, if at all it comes, only will come at high court or above for these kind of matters where amounts involved are huge. But then first see on materiality, is it a very, very small negligible amount for a larger scheme of the business, its operations, and whether you then want to see whether you want to dispute or litigate this further through the, the whatever are the channels of the proceedings which will be there. Only after that decide to go ahead. Otherwise, wherever possible, where amounts are small, I would say probably you may just ignore it.
And just to add to Rupa's point, probably if it is a material amount you still want to dispute it, probably you can take some cue from this Parmika judgment and place some grounds of argument.
Okay. Next.
Sir, moving to the second last query of today's session. It's a little complex. Sir, what is your view on input tax credit on business promotion expenses? Like I have purchased gold coin, I have given to my distributor. So what is your view on the eligibility of on credit on such gold coins?
Okay. So, okay. So this is a gift given to your dealers, if I can take an example. So primarily, if I look at section 16, certainly it is in the course and furtherance of my business. So section 16 gives me an entitlement for the credit. So at least to that extent, I don't see any challenge. But when I come to section 17, which is again, I said on overriding provision, 17.5 also overrides 16.1, this entire section of 16. So there, one of the restriction is on any item given away as a gift or a free sample. So when we are looking at a gift is generally what is given as a voluntary gesture, and there is no quid pro quo. So even in case of a gift, say this gold coin, can you take an argument that there is no quid pro quo, or can you say that I am giving this gift to my dealer to enhance my business further, and hence it is not a gift. It can be considered as a business promotion expenditure. So I think this matter has to be tested. If you ask me today, there is some element of risk involved. It is again how the courts will interpret the word gift, because it is something which is of a voluntary nature and there is no quid pro quo involved. But when I'm giving a gift as a gold coin to my dealers, can I say that there is certainly some element of quid pro quo wherein I get more involvement of my dealers, wherein it is going to enhance my sale? So I think this has to be tested and there is some element of risk. Rupa?
There is certainly element of risk, and already if you see the revenues way of looking at it is very, very strictly. There has already been 2 rulings on this, advance rulings obviously. Advance ruling is equal to adverse ruling, because they were most of the time, 99% of the times it will go against the SSC. That is how the present state and the situation which we are seeing. In a case called Biostat, exactly what Vikram has just now discussed had been addressed. And therein also they went with this gift concept. They said that, there is no supply, it is nothing but being given as a free, and it is hit by the 17.5, and they said reversal needs to be done. Similarly, recently there has been one more in a case called MERS, wherein again they had taken a similar contention to say that this is nothing but a business promotional expense or an item. There once again they brought in and they hit it down by telling there is no quid pro quo. It is nothing but being given freely. Where is any consideration or anything flowing against this item? That being the case, we are not going to permit the credit. This is what is the 2 recent rulings. One is a little older ruling, other is a recent ruling, but it indicates the mindset of the department. Having said that, you asked me my personal view. I would say, in spite of the ruling, the credit on the business promotion expenses should not be denied. But if the wordings used in the invoices, in the vendors, the procurement documents where you're purchasing these kind of items from a vendor is clearly setting out everywhere as gift, gift, it is like shouting out, then obviously you can expect department will not permit this credit at all. But wherever we can, it is booked as a business promotion expense. In the documents, it is coming through as a business promotion expense. There's some contractual understanding which is set across, telling if you lift this much of quantity, I'm going to give you, this much extra. Then possibly, this credit can be availed. In my view, it's very much a case which is ripe for a judicial clarity. So wherever the SSC is willing to take a chance, please do take this credit. But I would say there could be a litigation on this, and it will resolve only at the level of tribunal, or mostly likely at the High Court after
Rupa,
some maybe 6 to 7 years. Yeah.
If I can add to this, probably taking cue from what you said. So probably if your client or the assessee can prove that it is not a gift but an incentive for the past performance, and some kind of communication is also shared that as a return for the past performance, we are hereby giving an incentive in the form of a gold coin, and it is not a gift. So basically this quid pro quo can be established, and credit can be availed, but certainly, as she said, it may be tested judicially also. Yes, Arjun.
Yes.
Okay. Okay. So moving to the last query for today's session. Sir, I have incurred little expenditures on which ITC I have availed for expansion of my business to add an additional vertical. However, that additional vertical did not succeed. It got failure. So I closed such additional that vertical. So the ITC which I have availed on the expenses for the purpose of opening such vertical, is it eligible, or I need to reverse such credit?
Okay. In my view, it is clearly eligible, because the law does not require every expenditure to generate a revenue. So far and so much it is related to the course and furtherance of the business. Because for my furtherance of the business, I had tried to create a new division or a new revenue line. So though in spite of this being failure, it does not take away my attempt to further my business. So I don't see any particular challenge in this particular credit.
Yes, and there is also, to add on to what Vikram said, there are also decisions on this in the central excise itself. In Karnataka itself, we have a case of Reva Electricals, wherein, for the development of some new kinds of vehicles, they had incurred such expenses and credit had been availed. So therein they have said that these kinds of things are in the course of the business of the manufacturing activity which is being done, and it was upheld in favor of the SC.
Okay.
Okay.
Sir,
Yeah.
by this we have addressed all the queries raised for today's session. I would thank Vikram sir for your elaborate deliberation on input tax credit, and I thank Rupa madam for your valuable suggestions and value additions. Thank you, Vikram sir, and thank you, Rupa madam. And also, I thank all the participants for your patient listening and participation to our course. Thank you.
Thanks to all. Thanks, Vikram. Thanks, Arjun. Yeah.
Thank you.
Thanks to all the participants. Yeah.
Okay, thank you.